depending where you are. This is Keisuke Sadamori, the Director of Energy Markets and Security at the International the Energy Agency. First of all, thank you very much to everybody for taking part in this very important event, the fifth, the IEA-IEF-OPEC Symposium on Gas and Coal Market Outlooks. This is part of the collaborative programs among the three organizations, along with the Market Outlook Symposium by the IEF in Riyadh, and also the price formation, the symposium organized by the OPEC in Vienna. Thank you very much for your time. And this is a very important event. Now that we are seeing the increased momentum of the clean energy transitions, the world toward the decarbonization, I think it is very important for us to talk about the role and outlooks for the gas and coal in this very particular juncture. So thank you very much. We look forward to having positive and constructive discussions today. Thank you as well for the co-organizers, the IEF and OPEC, for working with us in the setting up this important event. Thank you very much for that. Now, without much ado, I think I would like to turn the floor to the head of the three organizations of this event. So let me start with the IEA's Executive Director, Dr. Fatih Birol, for the opening remarks.
Thank you very much, Mr. Sadamari. Dear colleagues, greetings to all of you from IEA headquarters in Paris, and please welcome to 5th IEA-IEF-OPEC Symposium on Gas and Coal Market Outlooks. This event is, I guess, for the first time we do it. It is available for viewing to public in order to boost the market transparency. And I'm very happy that all three organizations agree to take such a step. And before we begin, please allow me to offer my sincere thanks to two organizations, the OPEC, and it is head Mohammed. Thank you very much for the cooperation, and also to IEF, Joe. Thank you very much for the cooperation to jointly organize this symposium with the IEF. Two distinguished organizations and two distinguished leaders. Now, this symposium on gas and coal market outlooks has been an excellent platform since its inception. And we have the last one, if I am not wrong, in the year 2018 in November. And since then, many things have changed. One of the things changed is, of course, we all know, and our colleagues, our friends, beloved ones suffer. It is COVID. There have been more than 150 million COVID cases, and we have registered that over 3 million people lost their lives. And of course, the impact of COVID directly and through economy indirectly, it has major implications on the energy markets. But before going to energy markets, I should tell you that at the IEA, we are very closely following the vaccination around the world and how it goes through. And just in the past week, we passed the 1 billion vaccine doses administered worldwide. Of course, this needs to be much higher numbers, and there's in my view, a great job to be done, especially by the wealthier nations of the world who are capable of helping the others around the world. And we expect that this year a global economy will rebound, and the IMF comes up with around 6% growth of GDP, which is, of course, good for the economic recovery. And every year we have at the end of the first quarter, beginning of second quarter, we come up with our expectations. What happens this year in the energy markets? We call it Global Energy Review Report, and our numbers show, dear colleagues, a very strong rebound of the global energy demand, driven by China, definitely driven by China, but also United States, other Asian countries. Gas will increase, we expect more than 3% compared to 2019 levels before the COVID crisis, strong growth. Coal, we expect this year close to 5% growth, and it will be again coal consumption. We expect at the end of this year will be higher than at the end of 2019, and again driven by Asia and especially for the power sector. The growth in coal, gas, together with oil, it means the strong increase in global emissions, and we expect this year global emissions to grow about 1.5 gigatons. What does it mean, 1.5 gigatons? It means that it is the second largest increase of emissions in the history. So the point is here, what surprises us at the IEA, on one hand, there is a growing political momentum, as you might have seen in the last Climate Leaders Summit convened by President Biden. Many countries around the world committed themselves to have ambitious climate plans. On the other hand, say that when you look at the markets, we see the second largest increase of emissions in the history. So this gap between the rhetoric and what is happening in the real life is getting wider and wider, a point that I underlines. But of course, I am sure we all take climate change seriously. And I know very well that my friend Mohamed Barkunda was one of the leaders of the fighting against climate change at his capacity, attending several COP meetings there. And as we all believe, climate change is a key challenge for the humanity. We all wanted to see what the energy sector needs to do in order to reach our climate goals. Several countries today have agreed to bring their emissions to net zero by 2050. They have made strong commitments, and some countries like China set carbon neutrality by 2060. And there are different fora. One of them is a joint initiative of the United States with some oil-producing countries in terms of net zero producers group. Everybody is looking how to go there. So what we have done at the IEA, some of you know us very well, we believe in numbers. Even though we respect the rhetorics, statements, we believe in numbers. So what we have done is that we are coming up on 18th of May, only a few weeks from now, with a roadmap, what needs to happen in the global energy sector to bring the emissions net zero in 2050? And more importantly, what are the implications of a net zero 2050 world for the governments, for the energy producing countries, for car manufacturers and citizens and others? I would very much suggest you to have a look at it if you have time, because the preliminary the numbers and discussions I have with my colleagues indicate that the net zero 2050 world may well have serious implications for many countries whose economies are relying on the energy export revenues. Now, in terms of natural gas, one of the topics of today, we see that the natural gas, especially in the next few years, will be still an important part of the energy mix. But how to use the natural gas, especially addressing the methane emissions issue, is a critical one. Our studies show that the last year, 70 million tons of methane went to atmosphere, which is equivalent of, just put in a context, what is 70 million tons of methane? It is equivalent of the entire CO2 emissions of Europe. So equivalent to that was go to atmosphere, and our studies show that a big chunk of those methane emissions could be minimized, if not nullified, at zero net cost, or even better than that. So for gas, we think that there are a few areas that the gas industry may need to look into, ranging from the alternative gases and hydrogen in terms of biomethane and others. Coal, again, as I said, this year coal is growing very, very strongly. And the renewables, we all talk about the renewables. The growth of coal this year is 60% higher than all the renewables put together. Let me say it one more time, because I cannot myself have difficulties to believe, but it's the number. The growth of coal is 60%. How much coal comes to the market in terms of volumes is 60% higher than all the renewables put together. And it's mainly coming from, as I said, the power generation, but also iron, steel, and others. And this is a critical issue. And as we said several times at the IEA, one of the most critical, I can talk on my behalf, perhaps the most critical technology today the world needs to address the climate change, in addition to others, is carbon capture, utilization, and storage. And this is a very important technology, and I am very thankful to many governments, including United States, for example, including Canada, including Japan, Saudi Arabia, Norway, many countries, UK, consider carbon capture and storage as a key technology, as does the International Energy Agency. So, looking at the future a bit and finishing here, I believe no country, they have a net zero target or not a net zero target, they are climate change a key priority or not, no country will be unaffected from the clean energy transitions coming very strongly. So there is I can assure you that. So therefore, it is time to countries, companies position themselves accordingly in this context. And as the International Energy Agency, we are trying to find a way, and this is one of the key issues that Mr. Sadomari, our Director for Energy Markets and Security, is working on, how we can secure energy systems in a clean energy transition context. So we need both of them. And I can tell you that both gas and coal, together with oil, is expecting we'll have some uncertain times between the economic turbulences, COVID issue, but also political moves this in the climate change from key consumers and producers. So a meeting like this one, I hope to shed light on some of those formidable uncertainties. And with this, I thank you very much, especially to our colleagues from OPEC and IEF to organize this meeting with us. And I go back to Mr. Sadamari.
Thank you, Dr. Birol. Next, I would like to invite His Excellency Mr. Mohamed Barkindo, the Secretary General of OPEC. Mr. Barkindo, floor is yours, please.
Good afternoon, my friend Sadamori. I believe at the same time in Paris. I can say good afternoon from Vienna. It's a great pleasure to be with you for this 5th meeting of the IEA-IEF-OPEC Symposium on gas and coal outlooks. From the outset, I would also like to extend our deep appreciation to our friend, the indefatigable Dr. Fatih Birol, not only for hosting today's event, but also for setting the scene and the tone of this important meeting in the most clear manner in which he has just outlined not only what this meeting will face, but what our world would be in this transition. Allow me also to thank our colleague and friend, Joe McNomigal, the Secretary General of the IEF, for co-organizing this event with us in OPEC and the IEA. The origin of this event, as we have just heard, dates back to November 2011, when leaders at the G20 Kent Summit requested further work on gas and coal market transparency, and asked the IEA, IEF, and OPEC to provide recommendations in this field. This work was to be achieved through symposiums on short, medium, and long-term outlooks for gas and coal markets. The inaugural meeting was held in October 2012 and was followed by events in 2014, 2016, and now 2018, and now today's event, which is the 5th iteration. Today's symposium is part of our ongoing joint work program between these 3 sister organizations, which is comprised of 2 other regular dialogues in addition to today's event: the IEA-IEF-OPEC Symposium on Energy Outlooks and the joint IEA-IEF-OPEC workshop on the interactions between physical and financial energy markets. These 2 annual events were established and endorsed by energy ministers at the 12th IEF in Cancun, Mexico in 2010. These joint events have increasingly attracted high-level participation, and the important issues discussed have been elevated to the global energy agenda. Furthermore, our collective efforts through these dialogue initiatives have significantly strengthened the producer-consumer dialogue, and we look forward to further deepening our joint engagement through ongoing close collaboration in the years to come. In the past year, as we have just heard from Fatih Birol, the COVID-19 pandemic has served as a stark reminder of how crucial global energy cooperation is in confronting serious industry crises. supporting stable energy markets and fueling economic growth. After the life-changing events of this past year, it is almost hard to imagine that the last time we met for the fourth installment of this event was in November 2018, when we traveled to Paris, where the three organizations gathered together in person around the same table. It was a different world in 2018, and so much has changed since then, as Fatih just mentioned. But that was then, and this is now. As we are all realizing, we must not lament the days of old, but rather accept the new realities and adapt to them as efficiently and as effectively as we can. And indeed, that is why we are here today, to revisit the outlooks for both the gas and coal markets and assess not only how the COVID-19 pandemic has impacted them, but how they will evolve moving forward. Let me begin by emphasizing that all available energy sources will be required to meet rising global demand for energy. This is precisely what we heard from Fatih in his opening remarks. According to the latest edition of our World Oil Outlook, the global primary energy demand is expected to continue growing in the medium and long term, rising by a remarkable 25% by 2045. In terms of the energy mix, oil accounted for more than 31% of global energy demand in 2019, and is projected to remain the largest contributor to the energy mix to 2045, accounting for around 28%, followed by gas at about 25% and coal at almost 20%. Global gas demand is expected to continue growing, as we heard from Fatih, driven by rising levels of urbanization, increasing demand in the industrial sector, and greater competitiveness over coal for power generation. We thus see global demand for gas increasing from nearly 67 million barrels of oil equivalent per day in 2019 to about 91 million barrels of oil equivalent per day in 2045. Some of our member countries are substantial producers of gas and will play an important role in meeting this rising demand around the world. Looking at this from a regional perspective, natural gas is forecast to be the only fossil fuel for which demand will increase in OECD countries, while its share in the energy mix is expected to almost triple in India and to double in China. We see, however, a significantly different trajectory for coal. Although it is still expected to account for around 1/5 of the energy mix to 2045, despite what Fatih just shared with us in terms of the growth rate, especially during the outgoing year, coal is losing ground to other energy sources in the medium to long term. Around the world, and particularly in the OECD region, we are seeing coal-fired power plants being displaced by renewables and gas. And that's what makes the data that has just been shared with us by Fatih Birol very, very interesting. And we will all be looking forward to the release of this report to enable us to be more informed of these developments in these interesting times. The result is that demand for coal is projected to experience an average decline in growth rate of 0.3% per year from 2019 to 2045. In addition to the coal plant displacements, another contributing factor to this downward trend for coal is the gradual introduction of more energy efficient technologies in developing nations where lower carbon investments are being prioritized. India is one exception to this trend, with coal demand expected to increase between 2019 and 2045 at a rate of 2.6% per year on average. In terms of electricity generation, which is expected to increase by 2.2% per year, mainly in developing countries, gas next to renewables is projected to increase its share in the electricity generation mix. However, coal is expected to see only limited increases in power generation due to the aforementioned decommissioning of all power plants. Another factor worth mentioning that is being talked about more and more in our industry is the role of hydrogen. The cutting-edge innovation called blue hydrogen is derived from hydrocarbons and offers the potential to add significant value to our industry by turning emissions into energy. This technology and others such as carbon capture and storage, which has just been further endorsed by Fatih Birol, are providing viable options for energy exporting countries such as ours to diversify our economies while helping provide clean energy options for the future. And finally, renewables, namely solar, wind, and geothermal, are expected to be the fastest growing source of energy in both relative and absolute terms between 2019 and 2045, growing by 6.6% per year on average. All of these indicators and trends are taking place within a rapidly evolving energy landscape, in which we are seeing an intensified transition by major players in committing to a lower carbon footprint. In fact, just last week, as Fatih just mentioned, US President Joe Biden hosted a virtual leaders summit on climate, in which 40 leaders vowed to work together and do their part in meeting global emission reduction targets. The event signaled the return of the US to a leadership role in addressing climate change and comes at a critical turning point as the world gears up for November's United Nations Climate Change Conference, COP26 in Glasgow. OPEC has always held the view that the energy transition and the fight against climate change would be significantly impaired without the United States at the head of the multilateral table. At OPEC, we believe that the scale of the challenges that the energy transition presents will require us to utilize all available energies. We must seek out cleaner and more efficient technological solutions, such as the CCUS, while promoting the circular carbon economy as a means to improve overall environmental performance. Our member countries are very active in this regard, such as with the Saudi Arabia's recently unveiled Saudi Green Initiative and the Middle East Green Initiative. These innovative and timely contributions underpin global efforts to address climate change, while also respecting the core elements of the UNFCCC, particularly as relates to equity, historical responsibility, and national circumstances. This will ensure a balanced transition that accounts for the needs of people in relation to their social welfare, the economy, and the environment. My dear colleagues and friends, these are just a few of the key trends OPEC has identified for the medium to long term oil, gas, and coal market outlooks. I want to once again thank our co-organizers in the IEA and the IEF and the leadership that our friends Fatih Birol and Joe McNamee bringing forward to ensure that we are all aligned and we play our role as effectively and efficiently as our constituents will expect us to do in this transition. We look forward to hearing from our colleagues at both the IEA and the IEF, as well as the expert speakers we have assembled from both the public and private sectors, who bring a diverse range of knowledge and insight to our discussions today. Thanks also to our moderators for keeping our discussions. Our goal is to learn from each other's analysis and unique insights. After all, that is why we come together in forums such as this. And I know we will all leave here today having benefited from these presentations and insightful discussions. As we slowly emerge from a tumultuous year of crisis and chaos, we could all use a good dose of hope and inspiration, as we heard from uh, our friend Fatih Birol in his opening remarks. Uh, Allow me to leave you with the wise and encouraging words of the 13th century scholar Muhammad Jalaluddin Rumi, who said, and I quote, very interestingly, he said, where there is ruin, there is hope for a treasure, unquote. How apt, Fatih. Let us indeed move on from the ruin and the tumult of this year, past year, and continue onwards together, seeking our treasure, which can be found through close cooperation, mutual respect, and prosperity for this and future generations. Ramadan Kareem.
Thank you. Thank you so much, His Excellency, Mr. Barkindo. Cannot agree more to the value of international cooperation and amongst the organizations. Thank you very much for the very clear presentation. And next, I would like to turn the floor to Mr. Joe McMonigal, the Secretary General of IEF. Mr. McMonigal, floor is yours, please.
Well, thank you, Kaisuke. Good afternoon, or good morning, or good evening, wherever you are. Let me start by thanking my colleagues, especially Dr. Birol and the IEA staff for hosting this symposium, and to my friend, His Excellency Mohammed Barkindo, the Secretary General of OPEC, for participating and lending his important voice in this joint trilateral event. It's a pleasure to welcome you and all of our distinguished speakers to our discussion today. The exceptional circumstances of the pandemic still in our midst, combined with the urgent climate and sustainable development challenges we face, require an even stronger collaboration. The COVID-19 pandemic affects energy supply and demand profoundly, but fortunately our collaboration has never been better. Since we launched our trilateral work in 2010, in response to the global financial crisis, energy market dynamics are better understood, better regulated, and more transparent. In short, the producer-consumer relations we have built allowed us to respond faster and more effectively that resulted in 2020 becoming a transformational year in energy markets, international development, and climate ambitions as well. After witnessing a historic drop in demand in April of last year, as Dr. Birol refers to Black April, we now find ourselves in a gradual recovery, albeit a cautious one. The unknown duration of COVID-19 and all the associated economic impacts have a tremendous impact on energy sector investment. We see this playing out in terms of elevated levels of market volatility and uncertainty as the virus mutates and some countries experience renewed breakouts. While the continued global vaccine rollout has now reached 1 billion doses, as Dr. Birol has referenced, and shows promise, bringing stability to energy markets requires ongoing collective efforts in which the IEF will certainly continue to play our role. Fortunately, there are reasons to be hopeful. We've seen new initiatives by governments and industries that are creating a new energy and climate solidarity among the world's largest producers and consumers. The global momentum for a swift, fair, and sustainable recovery will only gather pace if we accelerate investment in innovative, clean technologies and enable their deployment at scale. So the IMF projects that the global economy will grow by 6% in 2021. Energy demand will return and can reach beyond COVID-19 levels as rapidly as China has shown. This will include both a rise for natural gas and coal demand, two sectors that require major investment in clean technologies to ensure that sustainable and climate neutral growth leaves no one behind. Coal has been referenced in the previous two remarks, represents close to 1/3 of all energy consumption and is the primary energy source for electricity generation. And coal is set to rise by about 5% this year after dropping 4% in 2020. Certainly concerns about air pollution and CO2 emissions will need to be addressed, especially in these emerging growth economies on which the global economic recovery depends. Natural gas, meanwhile, saw a 2% decrease last year, but is set to rise 3% in 2021, with most of that increase coming from Asian growth economies. Beyond the short term, the continued growth of LNG, increased coal to gas switching, and the rollout of emission reduction strategies will see natural gas play a significant role into the future, comprising about 20 to 25% of the global energy mix into 2040, according to the main scenarios. Indeed, all of our collective outlook scenarios show that that hydrocarbons continue to be a primary component of the current global energy mix. And therefore, it is even more incumbent than ever that the sector continues to rapidly advance clean technology investment, cooperation, and deployment. The quest for hydrogen at scale can help accelerate CCUS deployment and facilitate deeper integration of renewables into industrial clusters. While the OECD sharpens its focus on green pathways in the energy transition, natural gas remains the fuel of choice to enable successful transitions in non-OECD growth economies that will lead to the global recovery. The widening social divides between OECD and non-OECD regions means that affordable access to reliable energy remains of paramount importance to lift growing populations from poverty, improve lives, life expectancy, and equal opportunities between genders as well. Of course, continued growth in renewables and a refreshed look at nuclear power and a more assertive government push to employ circular carbon models will pave the way for a sustainable hydrogen economy and accelerate smart energy transitions. Several countries have raised their climate ambitions at the climate summit that the United States hosted on Earth Day last week. The summit, as Dr. Barol mentioned, also announced the establishment of the Net Zero Producers Forum, which includes 5 member countries of the IEF, including Saudi Arabia, Qatar, Canada, Norway, and the United States. We welcome this initiative that recognizes energy producers are an integral part of climate solutions that we all seek. The quest for net zero and a hydrogen economy can serve as an enabler to fast-track overlooked technologies such as CCUS and direct air capture, as well as those that are still under development but urgently needed to meet our climate goals. So in closing, let me just say that I'm sure today's dialogue will provide many new insights and help us turn challenges we're facing now into new opportunities. I want to thank Dr. Barol and IEA for hosting, and of course to Secretary General Barkindo and our OPEC colleagues for their contribution to this very important event. Thank you very much, and I look forward to our discussions.
Thank you. Thank you, Mr. McMonagall, for this the very clear presentation of the future energy mix, including the important role that the natural gas is expected to play. Now, after hearing the excellent opening remarks for these events, I would like to turn to the session 1. This session 1 is on the short-term developments in gas and coal markets, and this session will be moderated by Dr. Abdulrazak Ben Youssef, our dear friend, and he's the head of the Energy Studies Department of the OPEC. So without much ado, I would like to ask Dr. Ben Youssef for starting moderating this session. Floor is yours, please. Thank you.
Thank you very much, Mr. Chairman, and I'd like to welcome all participants, and I have the pleasure to moderate this session of the 5th IEA-IEF-OPEC Symposium on the coal and gas market. I would like to thank the co-organizer to make this event happen. Furthermore, I would like in fact to thank their excellencies for setting the scene and for their guidance in the opening session. Our session, on this session 1, will be focusing on the short-term development on the gas and coal markets, which will shed the light on what extent are coal and gas demand, supply, trade, and investment affected by COVID-19, and what is the trajectory for coal and gas market recovery in the post-pandemic, and for sure, and other related items. This will be under a couple of uncertainties, including government policies to support the sustainable long-term net zero goals have brought into questions the future evolution of these markets. Strong policy support for renewables, hydrogen, the circular carbon economy, plus electrification could also affect the future of both fuels. The key questions for our distinguished panelists are: to what extent are coal and gas demand, supply, trade, and investment are all affected by the COVID-19 pandemic? And what is the trajectory for coal and gas market recovery and the post-pandemic environment? In what way are higher in natural gas inventory levels having an impact on LNG trade and investment and LNG infrastructure? The third question is: how are policymakers incorporating coal and gas into post-pandemic recovery plans, and what does this mean for the short-term demand and sustainable growth? Those questions and others will be tackled by distinguished speakers in the session. As for the structure of the session, in the first part, three presentations, 10 minutes each, will be delivered by Mr. Peter Fraser from IEA, Mr. Zab Qureshi from IEF, and Mr. Dmitry Sokolov from GECF. Thereafter, we will have 20 minutes Q&A for the three presenters. Then 3 other presentations, 10 minutes each, will be delivered by Dr. Tatiana Mitrova from the Skolkovo Energy Center, followed by Mrs. Sarah Liu from Sunlight Cooking Group, China, and then Mr. Andrew Walker from Cheniere from the UK. Those 3 presentations will be also followed by 20 minutes Q&A for the 3 speakers. Should the time allow, we will have another round of the Q&A for all speakers. I would like to encourage all participants to send questions through the platform, indicating the name of speakers to whom the question is asked, and you will find in your screen an icon called the Q&A that can be used for sending the questions. Now let's start by the first presentation on the short-term outlook for natural gas and coal by Mr. Peter Fraser, head of the gas, coal, and power markets divisions at IEA. Mr. Fraser, please, the floor is yours for the upcoming 10 minutes.
Thank you, Dr. Ben Youssef, and good day, everybody. At the Gas, Coal, and Power Markets Division of the IEA, we do spend a lot of our time working on outlooks short and medium term for natural gas and for coal. And our medium-term outlooks, we issue an annual update every year. Our most recent on natural gas, Gas 2020, was issued in June of 2020, outlook to 2025. We did a similar report for coal in December, our Coal 2020 report. But we've been accelerating our reporting recently. The exhortation of our executive director, we now issue quarterly natural gas reports. The most recent one issued on the 15th of April. And furthermore, we issued a global energy review as part of a cross-agency team, which Dr. Birol referred to in his opening remarks. That just came out just 8 days ago. Now, in the 9 minutes I have remaining for you here, obviously I can't go into a lot of detail on all this work, but I do want to give you some of the highlights and some of the key points. But where I'd like to start is really to talk about natural gas and coal and the geographic footprint of each. If you look in the pie charts here on the left-hand side for natural gas, you'll notice how diversified the geographic footprint is for natural gas. We have large producing and exporting countries like the United States, like the Middle East region, like Russia, and also significant importing regions in Europe and in China. And of course, I could also mention Japan and Korea as significant importers, particularly of LNG. But the main point is that many countries are using natural gas. The situation in natural gas is very different from the situation for coal, which has really evolved over the last 20 years to be one where Asia has really become the dominant user of coal. China alone accounts for over half of coal use. When you add in India, the second largest user, Southeast Asia, and other Asian countries, you have 3/4 of the global coal use is from Asia. The United States and Europe used to be very important, large coal users in the world not so long ago, 20 years. Now together, the United States and the EU consume less coal than India does. So when it comes to the future of coal, that'll be very much determined by choices made in Asia. So now let me go over what happened last year in energy markets, and particularly in gas and coal markets, and what we expect to happen in 2021. As Dr. Birol indicated earlier, the pandemic was a real shock to the energy markets. And it also should note that both natural gas and coal are also sensitive to the weather. And there were a relatively warm winter in the Northern Hemisphere last year. And as a consequence of those things, both coal and natural gas dropped significantly last year. In the case of coal, its 4% decrease was its largest decrease since the Second World War. Natural gas, much smaller decrease at 1.9%, but that still matches with the decrease we saw in 2009, but otherwise the largest decrease we've ever seen. LNG was a bit of an exception. Despite natural gas demand decreasing overall, demand for LNG actually grew about 1% last year. Now, the recovery in 2021, we've had, of course, we expect a strong economic recovery. The latest IMF estimate is a 6% annual growth for 2021 over 2020. And also, this past winter was considerably colder than the winter before in the Northern Hemisphere. So when you add those two things together, you get very strong growth in all forms of energy, but including coal and natural gas. On coal, our actual estimate in our global energy review is a 4.5% increase in coal consumption for 2021. And for natural gas, it's also a significant rebound from the 1.9% drop to a 3.2% increase. Both fuels end up higher than their 2019 levels as a consequence. And LNG, which of course grew in 2020, grows even more strongly, 4% in 2021, which is more consistent with the recent growth that we've seen in the last several years in LNG. Now, when we start to break that down geographically, let's start with coal. You'll notice here that and no surprise compared to those pie charts I showed you earlier, that China accounts for the largest portion of that increase. As Dr. Birol emphasized, that's because of growth in both power and in steel making. On the power side, we expect an overall demand growth of between 7% and 8%, according to the latest estimate from the Chinese Electricity Council, consistent with what we expect. And we expect also fairly strong growth in India, although, of course, events of the recent days may cause us to question that. But what's interesting here is that actually both the US and the European Union are expected to have growth in coal consumption, which is somewhat surprising given the recent trend in both jurisdictions for coal consumption to be declining year over year. The explanation for that is found really when you look at the prices. And on this chart, we have the price of fueling coal-fired generation in the gray and gas-fired generation in the blue in the United States, in Europe, and in Asia. And when we look at what's happened to the gas price over the last year, we can see how how low it was last spring. In the United States in April, the cost of generating electricity with natural gas fell to very low levels. And as a consequence, particularly in the first half to 3/4 of the year, gas was a lot cheaper than coal and pushed out a lot of coal out of the generating mix in the United States. Same was also true in Europe to a great extent. Of course, they're also helped by higher carbon prices. But in the last few months, we've seen a real shift. The gas prices come up again, and you see that spike there in the US in February, where they had that great cold weather and the problems in Texas. And as a result, in the United States in particular, coal generation is back up on the rise. The Energy Information Administration issued its electric power monthly report for the first 2 months of the year, just 2 days ago, and has coal generation up 40% through the first 2 months of 2021. EU is up. It's much less. It's about 10%. China up 20%, but we are seeing certainly a rebound in coal-fired generation. In Asia, as you can see on the right-hand chart, although gas price did fall a great deal, improving competitiveness of gas, you can see coal is actually a lot cheaper. And so that price effect has a much smaller net impact on both coal, on coal consumption in Asia. Now, when we look at the geographic spread for natural gas and its decline in 2020 and growth in 2021, we see in 2020, which are in the gray bars here, we see the decline in most regions of the world, big exception in the Middle East and also in Asia Pacific, although that is primarily due to China. When we look at 2021, we see growth worldwide and in all sectors. We see the green there, which is the residential and commercial growth, and that's really primarily a weather effect. That's having a much colder winter this past winter than we had the year before. Blue, the industry, that's growth reflecting the much stronger economy, as is the growth in power generation. But note again, North America, and that's mainly the US, we see an actual shrinkage in gas-fired generation as there's substitution into coal. One of the things we look at with our medium term is the development of the LNG markets. That's obviously an area LNG has been growing much faster than gas overall for a number of years. And the question really arises whether supply is keeping pace with the fairly vigorous demand growth that we've been seeing. But thanks to the rather slow growth we saw in LNG in 2020, and then the huge investment announcements that we saw in 2019, where we had $65 billion worth of final investment decisions on new liquefaction facilities, we were able to say at this point that we don't expect LNG markets to tighten considerably, at least over the next few years. But the future of growth in fossil fuels, in particular natural gas, is really going to depend heavily on policy, particularly on climate policy. This is from our analysis from our colleagues on the World Energy Outlook. You can looking out to 2030, and in our stated policy scenario, we would expect natural gas to continue to grow out to 2030, but coal to actually start to go into a very slow and gradual decline. However, with more aggressive climate policies, that will need to change for both coal and gas. In the case of coal, by 2030, we would already need a strong decline, and that increase that we had in the STEP scenario disappears. But in the net zero 2050 scenario, which Dr. Bureau mentioned, we're going to have a full study coming out on May 18th. It's not just coal that has to decline and decline even more than it did before, but natural gas actually has to peak and start declining, at least as fossil gas, before 2030. So climate policy is really hanging over these markets and will have a big say about where the future of gas and coal demand go in the future. So with that, I'd just like to wrap up with the key messages, reminding you, 2020 gas and coal suffered similar fates with historic drops, with the exception of LNG. And we expect them to recover their 2019 levels in 2021, thanks to the economic recovery, and actually more normal weather also makes a difference. And Coal prices, which dropped a little bit last year, have firmed up this year, but gas prices, which dropped a lot last year, have seen a very strong recovery. Beyond 2021, we would expect gas to grow and coal to decline slowly, as the growth in Asia is enough to offset those plant retirements that we expect in the advanced economies. But LNG still grows. But all of this depends on future climate policy, and where both a strong reduction in coal consumption and beginnings of a decline in fossil gas demand will be needed by 2030 to achieve net zero in 2050. And with that, I thank you for listening and turn it back to our moderator.
Thank you very much, Peter, for the presentation. Now we move to the second presentation on the post-COVID-19 recovery, the short-term implication for the natural gas and coal by Mr. Aurangzeb Qureshi, Senior Analyst at IEF. Mr. Aurangzeb, the floor is yours.
Thank you very much, Mr. Ben Youssef, and thank you to your excellencies and distinguished guests for participating, and thank you again to the IEA for hosting this symposium. As the moderator mentioned, I'm going to be presenting on the post-COVID recovery and short-term implications for natural gas and coal. But before I do that, just for some background, I want to outline a cautious recovery is underway. But of course, I want to emphasize the term cautious. The recovery is still quite fragile, with some countries facing various virus strains and increased caseloads. Of course, our thoughts are with the Indian people and other countries who are facing renewed breakouts. However, we are seeing some light at the end of the tunnel. The International Monetary Fund lifted its global economic growth in 2021 to 6% after a 3% contraction in 2020, the largest increase in over 4 decades. Also, global oil demand growth is a traditional proxy for economic recovery. The linkage may not be as strong as it used to be, but nevertheless, the IEA, OPEC, and EIA project oil demand growth to be between 5.5 million barrels per day to 5.9 million barrels per day in 2021, with growth in the US, India, and China. And of course, with greater energy demand comes more carbon emissions. And so, as was mentioned, so we do see CO2 emissions rebounding in 2021 after declining almost 6% in 2020, which was the largest decline in history. And we can see in this graph here how the 2020 oil demand compares to 2021, and this year it has moved into the positive territory. So what does this mean for natural gas? Natural gas demand is expected to progressively recover in 2021 as consumption returns to pre-COVID levels in China and Japan. We're also seeing, we saw benchmarks converging in 2020 when demand for natural gas was low. And now as we approach 2021, we can see the divergence again, especially in Asia. Earlier this year were cold winters in some parts, combined with low natural gas supply sent prices skyrocketing. This is of course also due to the different price indexation in the different regions. But this volatility underscores the importance as well of demand and supply security and the importance of natural gas for these markets. So from an LNG perspective, LNG demand was stable in 2020, but will see a boost driven by continued Asian demand and available US supply. So to put that in perspective, Asia accounts for just over a third of US LNG exports, has accounted for since 2018. And as the economy picks up and as recovery picks up, this trend is likely to continue. However, other key players who might put more supply into the market can cut into that US market share in the near future. Implications for coal, we see a similar story. Coal surpassed pre-COVID levels in late 2020 and is set to rebound in 2021. Of course, China and India maintain positive demand growth after declines in 2020. Global carbon emissions, like mentioned earlier, are set to jump, largely due to the resurgence of coal use in the power sector. And major key exporters such as Australia, Indonesia, Russia should benefit in the short term. And we can see here in this pie chart, China has the lion's share of coal consumption in 2020. And in the next graph, we can see coal trade increasing by around 2% in both thermal and metallurgical coal in 2021. So what does this really tell us? In all scenarios considered, hydrocarbons are still a mainstay in the global energy mix, and therefore should be seen as an integral solution or integral part of the climate solution. At the same time, we are seeing increased policy momentum behind net zero strategies, ESG, the role of hydrogen, of course, and achieving climate goals. So how do we get to where we want? There's two main approaches. There's a zero-sum approach, which sees the two concepts as mutually exclusive, hydrocarbons, and then the goals that we want to get to. However, seeing it from that lens can have implications for energy security, can result in supply-demand volatility, may have energy access issues, and if we're just to focus on the hydrocarbon component, of course, can have climate issues as well. The other approach, we can call it the balanced approach or the all of the above approach. You have hydrocarbons, and then of course you see net zero strategies, ESG, circular models that can fast track, or the need to get to that point can essentially fast track greater investment in carbon management technologies. And I guess that's the key point. Technologies will have to play a key role in achieving climate goals. And the one key technology I want to speak about briefly is carbon capture, use, and storage. CCUS is a key carbon management technology that can balance both the future need for hydrocarbons while also mitigating the impacts of climate change. So it's kind of a balance between the two. CCUS is a vital element in combination with renewables and electrification for a comprehensive and robust emissions reduction strategy that can enable sustainable and inclusive energy transitions by mid-century. And it is also one part of an integrated circular energy model that enables sector coupling and the route towards net zero hydrogen economy. So you can see in the schematic here, it combines everything from renewables to hydrogen, to enhanced oil recovery, and provides a comprehensive, holistic solution to the climate. In combination with bioenergy and direct air capture, it can complement the net neutral application and work towards net negative emissions. So that would be removing carbon from the atmosphere. So in terms of applying this to natural gas and coal in the power sector, we can see here that according to the Global CCS Institute, that the majority of CCUS projects with the largest capture capacity in advanced development are tied to the power sector, mostly in the US. And this is, of course, due to a combination of financial incentives, regulatory drivers, and public-private partnerships. You can see here in the coal power, in the power generation coal sector, that the San Juan project in New Mexico is looking to decrease emissions by 90%, or approximately 6 million tons of carbon per year. Similarly, the Prairie State CCUS project that is also aligned with coal is looking to decrease emissions by 95%, or about 5 million tons per year. So CCUS provides a very verifiable and significant CO2 emissions reduction potential that must be noted. And of course, like I mentioned, the combination of financial and regulatory drivers can certainly help investment in this area, including the Section 45Q tax credit that has made the CCUS a very successful strategy in the US. CCUS can also reduce carbon emissions from natural gas processing, which has been the traditional application, but given the emphasis on zero carbon, net zero strategies, that can put pressure on natural gas producers. So what they can do in that case is track emissions from wellhead to import terminal and deliver carbon neutral cargoes with emission certificate as requested by importers, or importers can use CCUS during regasification. So there's a potential for CCUS to decarbonize the LNG trade, and that's an important development. Of course, enhanced oil recovery is a main revenue driver for CCUS, and more work needs to be done to find more markets and more ways to incentivize and finance CCUS projects. So that brings me to the end of the presentation. Thank you very much.
Thank you very much, Mr. Qureshi, for your presentation. Now, let's move to the third presentation on the GECF's natural gas and coal markets outlook by Mr. Dmitry Sokolov, Head of Energy Economics and Forecasting Department. Dmitry, the floor is yours, please.
Thank you very much, Dr. Benyusov. Good afternoon, Excellencies, distinguished participants, ladies and gentlemen. A very well greetings from Doha, Qatar. My personal wishes to those making the holy months of Ramadan in hope of gathering the beautiful blessing of peace, personal rewards, and good health. It's a real honor to be invited as a guest in the 5th IEA-IEF-OPEC Symposium on gas and coal outlooks. And GCF believes that today's symposium will prove that energy sector has a great chance to set things right by intensive actions towards implementing principles of carbon circle economy, and with the natural gas playing a central role. Of course, no doubt, we should be very cautious talking about the current situation and short-term forecast, because still we observe quite a strong development and strong increasing of the cases of COVID-19 all over the globe. And the forecast regarding the global growth remain highly uncertain. Even we should be very carefully taking consideration recent announcement by IEF with the upward growth countries. And of course, for gas exporting countries in particular, we have been hit by double whammy at this disruption coincident, not only by COVID-19 pandemic, but also a lot of geo-economical developments and oversupply, new emerging supplies in the market. At the same time, we have seen competitive natural gas and LNG prices have a predominant globally. And again, this was very good import strategies by our member countries. We believe that the large availability of resources and capacities, diversification of gas export routes, and efforts of producing countries to reduce costs and structural drivers for ensuring sustainable competitive natural gas will allow us successfully complete this tough period and move to post-COVID-19 recovery. And of course, we quite welcome increasing commitment to net zero emissions with the recent announcement by UN member states, Japan, South Korea, and China. And I should say that GCF member countries are also work very hard to develop pragmatic net zero emission strategies. And of course, we welcome establishing a net zero producer forum, mentioning that two of GCF member countries are part of this new established entity. We also witness a more extensive development of gas decarbonization option, LNG offsetting, CCUS, conversion to hydrogen. The decarbonization of gas offers significant advantage to this fuel to support carbon neutrality. And furthermore, we have seen several countries revising about their intermittent renewables ambitions and promoting EVs as part of clean solutions and post-COVID stimulus packages. And again, natural gas considered by them one of important part of this development. And for coal, definitely we see a revision of a strategy, particularly in EU, and they accelerated their phasing out agenda. We of course see quite a strong policy change in such countries of India, Bangladesh, Vietnam, of substituting coal to gas power generation. And again, we believe that this is a way to go. And of course, for number of conferences we all attended, transition to hydrogen economy become one of the main direction in the coming year. Regarding the natural gas, we definitely see as an entity involved in export, we definitely see positive trends in recent months. Of course, during 2020, we believe that, and it was mentioned, industry hit it very significantly and strong. However, with strong support from Asia LNG markets, we believe that in the coming months, we will observe quite a rapid rebound of the demand. Here it was mentioned that Asia Pacific, we believe, should be a key region. We need to look when we are talking about the short-term recovery of the demand. Very important to always consider that what we observe in the 4 months of 2021, particularly regarding the price development, is very different from what we observed in the beginning of 2020. Two spikes presented on this slide was very, very impacted on the bring the attention of all policymakers to the importance of stable and reliable supply of natural gas. And again, this volatility we observe should be avoided by all means. Regarding the short-term forecast, and we definitely see that oil index LNG prices are forecasted to average between 7.59 MBTU in 2021. Again, it's quite a strong development related to the demand from Asian countries. Very important development, of course, we see not only in short term, but also in mid to long term, because as we all know, the COVID pandemic significantly affected the global economy. By our estimates, we see that around 13 trillion GDP decrease compared what we projected pre-pandemic. Also, we always mentioned in the international conferences that it is very important to look not only to European policy. We definitely see that increase of population in Asia Pacific and Africa will be the main driving force for energy demand. And also we talked quite a lot on many occasions that now energy experts need to look very carefully into the rates of vaccination. The inadequacy of distribution of vaccination should not be followed in inadequate distribution of energy support for post-COVID recovery. Again, this is very important, nobody left behind. And again, in our outlook, we show that Africa and Asia Pacific requires quite a strong support in technological exchange, and this exchange should be done now, and particularly related to the technology related to energy transition. This slide we in GCF quite strongly promote on a number of conferences. We definitely see that coal peak was observed in 2014, and taking consideration that demand is going to be focused only for coal in Asia. At the same time, we believe that lots of development of gas to coal substitution will allow natural gas to overtake coal in a global energy mix after 2025. So next 5 years, in our opinion, will be driven by quite intensive substitution of coal-fired generation, and particularly in such countries as India. Let me just shortly stop on the key drivers of natural gas demand. We definitely see very prosperous perspective. Again, we draw on many occasions that we need to be very careful in rhetorics and practical life. Again, in all regions, in Asia Pacific, North America, Middle East, markets are responsible for more than 75% of total gas demand increase. Again, policymakers, we are mostly now located in European Union, where the gas is the only region going to decline in mid and long-term perspective. Of course, should be very cautious when they develop, because not taking into consideration the development is quite important. For natural gas trade, this we also mentioned on many occasions that LNG is going to be a primary driver for natural gas trade. We definitely see that in the coming months and year, the geo-economic disputes around the new pipeline project should be stopped and allow free flow of pipeline construction project to be completed. At the same time, I would like to draw your attention that according to our estimates, natural gas trade will be one of the drivers for economic recovery. We definitely see that estimations that it can reach almost 2 trillion cubic meters in the next 30 years is possible. Again, main drivers for such kind of import is going to be located in Asia. And again, GCF member countries are well positioned and ready to supply this increasing demands. Today, we definitely need to talk about the issues of efficient reduction of CO2 emissions, moving to net zero. As I mentioned, it's one of the key priority of discussion in GCF platform. All our member countries are committed to Paris Agreement. We definitely work hard, and one of the example of this work is establishment of a gas research institute in Algeria, which will work on the issues of decarbonization of gas. But even today, we definitely see positive examples when decarbonization of gas is implemented by many of our GCF member countries. And last but not the least, definitely our platform discuss today on the gas and coal. However, taking consideration the practice we observe on other platforms, hydrogen become an integrated role on discussion of the future of gas, because definitely technology of production of blue hydrogen is well developed. It's ready to be implemented. Most of GCF member countries start quite intensive preparation for introduction of large volumes of blue hydrogen to international markets. And again, we believe that natural gas will quite strongly support transition to hydrogen economies, providing almost more than half of necessary resources for hydrogen. In conclusion, I would like to draw your attention that, of course, we in natural gas world is used to face uncertainties, but we managed time and time again to thrive. In fact, it is during challenging period like currently that our ability to respond quickly and efficiently to changing dynamics and market fluctuation becomes even more evident. And I should point out that GCF member countries are among the lowest cost producers globally, and they proved to be during pandemic 2020. And we are able to weather the current storm in any other. And of course, GCF now represents 70% of proven natural gas reserve, and we are well positioned to supply. Also, I would like to thank IEA-IEF-OPEC for inviting GCF. I would like to reiterate readiness of GCF based on concluding statements of 16 international energy forum ministerial to be actively involved in the platform. And definitely we are ready to host events related to the forecast of natural gas and other gases here in Doha. And we again are looking forward for more cooperation with all three organizations. Thank you very much.
Thank you very much, Dimitri. And now, in fact, I would like to thank the three distinguished speakers for their insightful thoughts on the post-pandemic recovery of the gas and coal markets in the short term. We will have a few minutes for Q&A for the three presenters. And again, I encourage participants to send their questions through the Q&A in the platform. Let's start, in fact, by Mr. Peter Fraser. The first question is, in your presentation, you indicated that coal and gas demand have been strongly affected by the pandemic, mainly in 2020. Similar to many other commodities, you have also mentioned the pathway for recovery. However, in addition to uncertainties you have already pointed out, most recently, last week, further announcement related to climate policy took place. The question is, what would be the effect of these new policies on the present recovery trajectory in the medium term?
Well, thank you for the question. It's certainly one that we are actually in the process of addressing. Our new report on net zero in 2050 that will come out the 18th of May will actually have a more detailed and quantitative answer to that question. As Dr. Biel emphasized, it's not just the targets that we need to set, but the targets followed by the actions. The May 18th report will set out the actions that will need to be taken, and then, of course, the consequences for the trajectories of both gas and coal, as well as oil, of course. So so the short answer is, when the policy announcements are followed up by policy actions, then we'll start to see a real change in the trends. Otherwise, the trends are for gas to increase and coal to slowly decrease. Thank you.
Thank you very much. Another question is to Mr. Qureshi. In fact, in your presentation, you have discussed, in fact, many aspects related to gas and coal. And the question is, how do you think the movement towards environmental, social, and governance, ESG, will impact natural gas and coal in the short term?
Yes, thank you, Dr. Ben Youssef, for the question. It's a very relevant question, I think. There is a lot of momentum on ESG right now, especially for investors who don't want companies to be investing in what they consider to be stranded assets, or for investors who want companies to act in more sustainable ways. So I think that in this case, that can put pressure on producers to act in sustainable ways, or to decarbonize their operations, or increase the efficiencies as well. I think I will revert back to my original point on technology. I think CCUS can offer a solution here that would allow these producers and for companies to decarbonize, while at the same time continue on with their operations. I think the key challenge here for technology is to seek ESG compliance and to make a push to ensure that technologies, clean energy technologies, including CCUS, can get that ESG compliance. And I think that will be a major theme down the road.
Okay, thank you very much. Now a question to Mr. Dmitry Sokolov. In your presentation, you have focused not only on the short term, but also on the medium and long term for gas market. One question is that after the period of relatively modest LNG demand growth in Asia since 2018, we have witnessed a strong growth in the recent months. The question is, how do you see Asian gas demand growth in the short to medium term, and what does this mean for the global supply-demand balance?
Thank you very much for this question, and definitely one of the key topic for GCF is to look to the new evolving markets, and definitely we believe that Asia, and particularly Asia Pacific with ASEAN countries, are quite a strong candidates for increasement of natural gas demand. At the same time, we need to look into OECD countries' history and pathways which was chosen, particularly after Paris Agreement in 2015, when a large scale of coal to gas switching allows many countries, for example, United States, to significantly reduce CO2 emissions, can be a good example of immediate actions which can be done in Asia countries. And definitely many of policymakers in that region is now considering or start to implement policies related to more penetration of natural gas to their energy mix, to immediately receive, not in 2050, but before 2030, quite significant reduction of CO2 by their countries. In our estimation, we definitely see 2021 very promising year for natural gas demand in Asia. We see increase, for example, for LNG can reach definitely over 5 or 6%. We definitely see that it is important to understand that consumers in these regions will be more and more in business related to receive carbon neutral LNG shipments. And again, GCF already last year and this year provided such kind of cargoes to that region. Again, we believe that in the coming decades, the central opportunity for net zero movement should be immediate implementation of certain circular carbon economy principles based on natural gas consumption. Again, this is quite strongly reiterated in all GCF principal documents, including our summit. And again, I should say that in the upcoming 6th GCF summit of heads and states and governments, this topic of post-COVID recovery based on natural gas is going to be one of the priorities. Thank you.
Thank you very much. I have a couple of other questions, but I don't know whether the time will allow. Let's in fact ask one question for this speaker. I return back to Peter. It has been in fact seen the raise of awareness about the hydrogen, including green and blue hydrogen, which they will have certainly in fact certain complementarity and also competition in the future. One question is, what would be the opportunities and challenges of hydrogen on coal and gas demand?
Well, thanks for the question. On blue and green hydrogen, this is something we weighed in on our Future of Hydrogen report back in 2019. And we were at that time, because of favorable economics, much more positive on blue hydrogen coming mainly from natural gas. So we see a potential additional demand for natural gas, depending on what the hydrogen is being used for, in blue hydrogen. That said, since 2019, the economics of green hydrogen continue to improve. And while not the case in the immediate right today, the prospects are improving that, say, in the next couple of decades, that green hydrogen could become a lot more competitive relative to blue hydrogen. In which case, that of course will have quite a different impact in terms of gas demand. So at this point, this is something we'll elaborate a little more on May 18th. In terms of what kind of hydrogen that we're talking about, so how much is coming, because it also matters, of course, for electricity demand. So this is something that we'll be addressing in the May 18th report.
Okay, thank you very much. A question to Mr. Qureshi. How can you, in fact, can governments incentives greater investment in clean technologies to enable more sustainable practices?
Yes, thank you for the question. Of course, clean energy technology investment is a big topic right now, and I think it comes down to, I mean, there's different tools available, such as tax credits, grants, public-private partnerships, government equity. So there's all these financial incentives that are already in place. The how really comes down to the unique circumstances of the jurisdiction, the company, and the project that they're trying to implement. So there are best practices available, but there's no blueprint. And I think that's where governments need to be creative and to stack incentives that best fit the situation in this case. And of course, like I mentioned, that grants, loans, accelerated depreciation on assets to reduce the tax burden, as well as government equity in projects that can slowly to de-risk the investment as well. So that's just a couple of thoughts on that.
Okay, thank you very much. The last question for this part is to Mr. Dmitry Sokolov. Since late 2020, the EU CO2 price has increased by around, I see some reports, 80%, and is today at the levels almost 50 euro by a ton of CO2. The question is, what does this mean for the European gas demand?
Thank you very much for this question. And definitely European market for most of GCF member countries is one of the key market to supply, and all developments are quite sensitive related to our member countries planning to supply natural gas to Europe. Definitely we observe increase of CO2 price on the markets like you mentioned, and this definitely allows to implement the mechanism of decarbonization and supply to this market quite a new products, and including I mentioned LNG, green LNG. At the same time, for European Union, we encourage all stakeholders quite intensively bring to European Union policymakers quite positive attributes of natural gas. And we definitely see that it is very important that in the coming weeks, European Commission classified natural gas as sustainable in its first green taxonomy list of energy sources. So for the coming weeks, it's going to be one of the critical decision by European Commission and European Union. So again, we definitely looking forward for more dialogue. And here we definitely call for this dialogue, and all producers and exporters to European Union are ready to be involved. And as I mentioned, GCF is a well-positioned platform to facilitate such kind of dialogue. And we are, of course, looking forward for more coordination with all three organizations. Thank you.
Thank you very much, and thank you for the speakers for this part, the first part. We have around 7 other questions in the chat box or the Q&A box, but unfortunately we cannot ask all of them. And also I encourage the speakers, if you'd like to answer some questions in writing, it would be great. And if you have time at the end of the session, we can also ask the questions. Now we move to the second part, which is the other 3 presentations. We'll start by the first one on the new trend of the gas decarbonization as a new normal and related producers' effort by Dr. Tatiana Mitrova, head of the research at the Skolkovo Energy Center in Russia. Tatiana, please, the floor is yours.
Thank you so much. Thank you. And I'm really so happy to see all the familiar faces. I was very much missing everybody during this year. So at least remotely, I'm very glad to see you. And it was very interesting to listen to the previous presentations. They gave a lot of inspiration and a lot of positive messages. What I will try to do is actually to bring up some new concerns and some new questions which are coming up primarily for the producers, for the natural gas producers. I will focus obviously on the natural gas. May I ask please to share my presentation? I will start actually with going back to the questions that were raised already in the previous part of this discussion. The implications of COVID-19 for the natural gas markets, we cannot say for sure what they are all about. We see the changes, we feel them, we can build some hypotheses how exactly they will affect the markets, but we cannot assess properly the depth of these changes and the speed of these changes. What will happen with the demand, with interfuel competition, with the role of gas in energy transition? What will happen in this competition between decentralized and centralized energy supplies, as more and more people are working remotely and the very way of business organization is changing? What will happen on the supply side with the ability to invest, with the new FIDs, with the investors' attitude towards gas business, with the companies' abilities to invest? Dmitry Sokolov was mentioning that basically most of the producing countries, they have experienced a real revenue shock last year. And at the same time losing incomes and having this duty to support their suffering population and businesses, they are all now in quite a difficult situation. So for the NOCs, it will be the question how much of investments they will be able to attract, and for the private businesses, it's also a question mark. Changes in the supply chain, they are happening. And of course, prices. There were already several presentations focusing on the recent price spikes, and this incredible volatility on the gas market is definitely a challenge, not only for the consumers who are, of course, suffering, but it is also quite a disturbing signal for the producers who see their market being undermined by this price instability, and it is creating basically problems for everybody. So demand, supply, prices, we frankly have very little understanding how exactly it will evolve in the next 2, 3, 4 years. We do not know, and it was...
Mrs. Metrova, can I ask, just sorry to interrupt, just I will ask our colleagues at IEA just to share your screens. I don't see the
now it works. Thank you so much. Okay, the next slide, please. Actually, these are some numbers which I think all people working in the gas industry know pretty well. This is demand uncertainty that the companies are facing right now when they are trying to make their FIDs. And I mean, we've always had this broad range of expectations, but right now it's becoming just incredible. And especially if we go back to the wonderful presentation made by Peter Fraser, who was saying that natural gas has to peak by 2030. Today, going for any FID is becoming a really very strong bet from the investors and from the natural gas companies. We do not know how fast the recovery will be in the short term, and especially again, looking at all these dramatic situations in India, in Brazil. I mean, that is really raising a lot of concerns about the global recovery, the speed of the global recovery as well. So this situation of uncertainty, that is something becoming really dramatic. Differently from the oil market and coal market to a certain extent, LNG and natural gas market, it was not tight before the crisis, before the pandemic, and it is not even now, it is not tight, and it will not be tight for the next couple of years. So maybe until, I don't know, 2025, 2026, we do not see any signs of this tightness. And then after that, in 3-4 years, there will be already this threshold of 2030, when, as IEA says, actually natural gas demand should start to decline. So it's really very tricky situation and very difficult situation. And in these circumstances, shorter term, smaller size investments are becoming more reasonable for the private companies. Or, on the other hand, another marginal part of the market players, NOCs, which have strong state support, they can also build up their positions. So we see here evolving very strange and interesting competition between state financing and state support, and different types of hidden subsidies, which is probably a new sign and a new component of the energy transition for the fossil fuels. Lower cost natural gas producers. And here I'm talking both about low costs in terms of traditional lifting costs, but also low cost of capital, which is, for example, applicable for the US producers. Yeah. They will be leading this process, and we will see most likely increasing competition for the market share, in particular between these lower cost producers. And the third component, which is becoming really visible in this, even in the short-term market, not even mentioning the longer-term market, it is decarbonization, which again was mentioned by all the previous speakers. But here we have some bad news, I'm afraid. Could we please go to the next slide? Decarbonization, I remember all our discussions a year or two ago when in the gas industry there was this hope that decarbonization will provide new sources of revenues, that it is a premium market where gas producers could grab some additional margins and so on. Currently, looking at how exactly this whole market and regulation is evolving, I'm afraid there will be no additional market premium. There will be no additional margin for decarbonizing. It is just the license to operate. It is the must. It's not a luxury. And so the companies, producers will have to increasingly invest in different decarbonization efforts. And frankly, they have plenty of opportunities to do that, but they will not be most likely rewarded for these investments. Just to stay in the market, they will have to do this whole work and to reduce their carbon footprint, which is also challenging. So we have high risk concerning the demand trajectory. We have rising costs on the production side due to these necessary investments in decarbonization. And we have also, it was again mentioned today many times, this longer term future, which is related to the deep decarbonization, to hydrogen and CCUS. And here, I mean, I love all these areas, and they are looking extremely promising, and it's impossible to imagine net zero economies without hydrogen and without CCUS. But frankly, from the producer side, there is a slight problem. They are not working economically at the moment. I mean, all these investments in these technologies, they are, it is early stage. These are TRL 3, 4, 5, 6. So it's not mature technology. There is no market. There is no market at all. I mean, you cannot find quotations for hydrogen prices, or you cannot find a standard contract for hydrogen supply. And most of these projects are actually working only with some sort of the state subsidies or if we have high price of CO2, which is not the case for the majority of the economies. So this is also big challenge for the natural gas producers, even if they have accepted this idea of energy transition and need to decarbonize their products. It's very difficult to start doing it right now without any immediate economic remuneration or any immediate stimulus, just investing plenty of money, because both CCUS and hydrogen are really very expensive. And so ending up my presentation, I will just draw your attention to the upper right side of my graph, which is showing compilation of all possible ways to decarbonize for the oil and gas companies. And you see that carbon capture, utilization, storage, and hydrogen, they are in the lower right corner, but in the upper left corner, there are many things which are simple to do, quite cheap, a bit boring. Yeah, they are about routine operations, but extremely efficient. These are the low-hanging fruits which most of the natural gas producers can deliver with no or really low costs. These are efficiency improvements, methane emissions reduction, flaring reduction, and other really simple things which are anyway, which should be done anyway. They are providing up to 50% of all carbon footprint. And so therefore, my feeling is that in the next, in the short term, 3-5 years, this might become the key focus, not CCUS and not hydrogen, but these operational improvements will become the key focus of the natural gas producers in their decarbonization efforts, because as I've mentioned already, they cannot avoid doing these efforts. It is their license to operate. So I'll stop on that, and thank you so much for your attention.
Thank you very much, Dr. Mitrova, for the presentation. Now we move to another presentation. It has been mentioned by the previous presenters, the importance of China in terms of coal demand. And this presentation will be in the coal market in China in the short term by Mrs. Sarah Liu, General Manager, International Trade Department in the Sunlight Cooking Group in China. Sarah, please, the floor is yours.
Hi, thank you. Hello, everyone. Thanks IEA inviting me to speak on China's coal markets in the short term. Next slide, please. Let's have a quick look at Sunlight snapshot. Sunlight is one of the top 3 Chinese merchant coking groups producing new carbon materials with integrated cycle of coal, coke, gas, and chemicals. Currently, we have 5 million ton coke capacity in operation and 4 million ton new capacity under construction, which will put into operation by end of this year. I'm not going through the details, just leave the information here for your reference. For me, I'm in charge of international trade, focusing on coal and coke, also chemicals. We would like to establish and expand the business relationship with the global clients. Next, please. Today, my speaking will focus on the short-term coal market, how China's coal market is affected by COVID-19, and what's the trajectory for coal market's recovery post the pandemic, covering the topics of Chinese coal supply, demand, price, and imports. Next, please. The COVID-19 brought huge impact on China's economy and social life. Major economic indicators plummeted in the first quarter of last year, but the economy started recovering from the second quarter when stricter COVID-19 control measures were introduced. The major economic indicators keep steadily recovering month by month. 2020 GDP grew 2.3% and realized the 18% growth in the first quarter of this year. Manufacturing PMI showed a V-shaped reversal from last March and has been standing above 50% for 13 months. Next, please. Let's have a look on China's energy consumption mix. For the sake of air quality control and environmental protection, China has made great efforts to control coal consumption and develop renewable energy in the recent years. The energy consumption structure continues improving. 2020 coal proportion decreased to 57%, and the proportion of non-fossil energy rate increased to more than 15%. The coal proportion will continue to reduce in the future. Next, please. Overall, the coal supply was affected shortly by COVID-19 and recovered rapidly from last March, given the government introduced the supporting measures to secure coal supply. 2020 raw coal output was 3.9 billion tons, growing 1.3%. From 2016, China conducted supply-side reform, totally phasing out 980 million ton coal capacity during 2016 and 2020. Meanwhile, big new efficient mines put into operation, mainly locating in Western China, leading coal production to concentrate to the west. The coal output from the top 3 provinces accounts for more than 70%, and coal production from the rest of provinces keep declining. This brings risk for the coal supply and logistics. Coal supply guarantee measures are still in place, and coal production remains growing post the pandemic, but still has some constraints. Coal production is still limited by safety and environmental protection inspections, sales quota control, coal-related corruption investigation. In terms of 2021 lookout, the total raw coal output is expected to increase by 2% to 3.98 billion tons. Next, please. The impact of COVID-19 on coal demand side is bigger and lasts longer. Coal demand recovery is lagged, but picked up remarkably from last May. The major productions from downstream sectors like power, steel, coking, cement, and chemicals all realized positive growth in 2020. As a result, 2020 total coal consumption grew 1.5% to 4 billion tons. Regarding to coal consumption structure, 52% of coal is consumed by electricity generation and 14% by coking. In terms of 2021 outlook, coal consumption is expected to grow by 1.2%. Next, please. Post the pandemic, along with the economy recovery, the coal stock continues dropping, driven by strengthening downstream productions and constrained coal supply. Restricted coal imports also tightened the coal market. Currently, it is the off-peak season for thermal coal demand. Historically, coal stocks at northern ports rise and end users build up stock. But this year it drops significantly, and this supports the coal prices. Next, please. In 2020, the coal price showed big volatility in China's market. The average price dropped slightly on the year-on-year basis. Qinhuangdao 5500 coal include a VAT included price down 3% to $83 per ton. PLV hard coking coal price at Jintang Port, net VAT down 1.2% to $192 per ton. Periodically, the coal price rose shortly right after the COVID-19 outbreak, caused coal mines resumption delayed after the Chinese New Year holiday, and coal transportation limited due to lockdowns. From last March, coal supply recovered rapidly, but demand remained sluggish. Coal price was then pushed down sharply. Along with coal demand picked up from May, coal price rallied strongly. In the last quarter, the coal demand continued strengthening while coal production slowed due to sales quota control and the investigation on coal-related corruption. As well, tightening restriction on coal imports made matters worse. So the coal market further tightened and the prices surged, especially thermal coal. Qinhuangdao 5,500 coal VAT included price soared to $122 per ton at the end of 2020, further rising to the historical high of $155 per ton this January. In terms of coking coal, the premium hard coking coal price at Jintang port, net VAT rose to $224 per ton at the end of 2020. For stabilizing coal prices, the government introduced the supply guarantee measures, such as requiring coal mines to operate at full capacity, relaxing sales quota, also increasing coal imports. Thermal coal price dipped dramatically as a result in January and February, but coal price rallied from March, backed by growing demand, constrained supply, aiming resuming sales quota and low stock. China's rising coal price and increasing import demand boosted the international coal prices, except for Australian coal. For the from these graphs, we can see the prices of imported coal, the green lines, keep same trend as domestic coal, but Australian coal prices, the red lines, remain weak due to the coal imported from Australia restricted. Next, please. Coal imports. China is the biggest coal importer in the world. Overall, the coal import is regulated by the government policy with a target of keeping coal imports reasonable, filling the domestic supply gap, but not squeezing domestic market. Coal import restriction is a long-term strategy, mainly on thermal coal, given plenty of domestic resource. The restriction enforcement can be adjusted flexibly and periodically based on domestic supply and demand condition. For securing coal supply in the fourth quarter, coal import restriction was lifted for non-Australian coal. As a result, the coal import surged to a historical high of 39 million tons in last December. Next, please. From origins, Indonesian coal import keeps growing and dominates the thermal coal imports to China. As well, Russian coal import increased obviously over the years. Australia and Mongolia coal are major sources for coking coal imports. From last October, Australia coal is restricted and unable to declare at China's customs. Australian thermal coal is fully filled by Indonesian, Russian, and other countries' coal, but Australian coking coal is difficult, fully replaced by other origins from the perspective of quantity and quality. So coking coal import declined in 2020. Next, please. Summary. COVID-19 pandemic brought a short impact on China's coal supply, while coal demand was hit more, but is recovering strongly post the pandemic. Coal supply and demand are expected to continue growing in 2021. However, coal production still has constraints. Chinese coal prices are strengthening, backed by growing demand, constrained supply, and low stock. China's coal imports remain strong despite under restriction. Thermal coal imports from Indonesia and Russia keep growing and fill the absence of Australian coal. But Australian coking coal is difficult to be fully replaced by other origins from quality and quantity perspective. Next, please. This is what I'm talking today, and this is my contact details for your reference. Thank you for your time and attention.
Thank you very much, Mrs. Liu, for your presentation. Now we will conclude the session by a presentation on the LNG market flexibility and short-term recovery by Dr. Andrew Walker, Vice President Strategy at Cheniere. Dr. Andrew Walker is the Vice President for LNG Strategy and the Communication for the US LNG exporter at Cheniere. Dr. Walker, please.
Thank you. Thank you, Dr. Ben Youssef. Hopefully you can hear me and see my slides.
Yeah, very good, yes.
Yeah, very good. Thank you. Your Excellencies, distinguished guests, it's my very great honor to talk to you today on behalf of Cheniere. We're very pleased to be invited by the three host companies to give you our thoughts today. We've heard some excellent presentations that really set out the dimensions of what has been happening in gas, in LNG. So what I want to do is really give you some pointers from the perspective of a US LNG exporter in terms of how you can think about the market, think about what has been happening in the past year or so, where we are now, and hopefully some pointers about how to think where that takes us as we look forward. As I do this, of course, I do have to point out the presentation is made under our usual safe harbor statement. So I think it's fair to say in LNG, we're now in a period where US exports are having a significant impact on the dynamics of the marketplace. You can see in this slide the various trains, the six operating projects that have come on since the first cargo sailed from the lower 48 from the Sabine Pass facility in early 2016. And you can see just how rapidly that capacity has grown. The US now, in terms of operating capacity, is equal second with Qatar at 77 million tons and is one of the big three exporters alongside Australia. So it's been a rapid rise in capacity, which has really changed the supply-demand balance. It's made LNG more available, but also it's changed the dynamics of the market in terms of the market structure. Destination flexible cargoes coming from the US have made LNG much more flexible, more liquid. And it's interesting to note as we look at the numbers from the LNG Importers Group published yesterday, GIGNOR, although they agreed with what Peter said earlier, it was a relatively low growth year for LNG, 1% or less than 1%. Actually, spot cargoes grew significantly. Spot cargoes grew 30 million tons, increased market share by 8%. It's the US, amongst others, that is driving that, but the US is a big driver. So it's no surprise that as the US has grown, we're seeing big increases in spot traders. Those destination flexible cargoes have an impact. Third way that the US has impacted the marketplace, we can start to understand if we look at the dynamics of the market last year. And really, to understand the dynamics of LNG, you really only need three charts. You need supply, Asia Pacific region imports, Europe as the balancing market, LNG imports. And I'm showing you 2020 versus 2019. I put a dotted line of where we might have expected 2020 to be were it not for the pandemic, based on where we were in Q1. And you can see in the middle, unusually, Asia as the demand driver. It's very unusual to see Asia not grow, but in fact, it not only didn't show strong growth, during the height of the pandemic, it dipped down below where it was in 2019 and actually showed contraction. That led to LNG volumes starting to get pushed into Europe as the balancing market. You can see Europe stayed quite robust through May. But as capacity started to fill with gas demand down, folks started to get worried that Europe was going to run out of gas storage capacity. And so actually something happened that is very unusual for the industry. If you look at the left-hand side, you'll see supply started to come down. And this was not just one or two, there was supply across the board came down, but in particular, we saw something quite new, which was the US as a flexible supplier, and it's the off-takers that own the volume flexibility there, starting to come down quite considerably and starting to mitigate the oversupply on the supply side. You can see that a bit more clearly in this diagram, where you can see the US liquefaction capacity on the left, the utilization factor dropping to 33%. That's very unusual for the supply side to turn down by quite as much of that as that. Normally it's a percentage point or two. And then the important thing to also notice is that it wasn't just the turn down that was important. It was also the turn up. As Asia started to recover, as we started to see demand, robust demand growth in Q4, we saw the US respond to that and increase supply in terms of feed gas into the plants by 8.5 BCF a day. In European units, that's 240 million cubic meters a day, about the equivalent on an annualized basis of about 85 BCMA on an annual basis. Significant turn up that helped manage the market on the way up as well. And I think it's fair to say if we hadn't had this new facility in the marketplace, it would have been a much more disorderly transition through the downturn and the recovery that we saw in LNG. So where are we in Q1? Well, we are seeing, as you can see from the same charts as I showed you just now, but with 21 on there, we're seeing a very robust growth in Asian Pacific imports. Asia was actually up 11% in Q1 year on year, led by China, which actually imported 5 million tons more year on year. But it's not just China. Strong growth in Japan, Korea, Pakistan. So not across the board, some areas showing weakness. India is a very price sensitive market, down year on year, but actually overall Asia showing strong growth. If you look at the left, you can see that actually Q1 is more or less the first time in 4 quarters that we've actually seen we've seen a positive supply growth year on year, but actually if you kind of add together those 3 dots mentally, it's a very small positive supply growth. Supply is not keeping pace with Asia Pacific demand. The US is up 17% year on year in the quarter. So we are seeing some outages in non-US capacity in various places that are kind of dragging the supply growth down. At the same time, we're seeing Europe start to step up as well, because Europe, as we'll see in a minute, is understored in terms of gas in storage. And it's now having to start to compete to pull LNG into the European market to bring itself back in line with where it wants to be. And so we're actually seeing a much tighter market this year than we saw last year, through last year. Slightly unprecedented gas demand impacts, but actually we're stronger than I think most people thought we would be, even as we recover. And if you look at the indicators of that, in the middle, you've got European gas hub price, TTF, showing just how strong European prices are at the moment compared to where they were at the height of the pandemic last year in Q2. On the left, you can see, as I said, Europe has come through a quite cold winter, and actually it's been very cold recently in April. Not only down significantly where it was in terms of storage fill last year, but also down on the 5-year average. And if you look on the left, the other balancing piece, the US as the balancing supply, you can see the cumulative cargo cancellations we saw last year as published by Platts. Cheniere doesn't comment on its customers' cancellation choices. You can see that actually by this time last year, June, we were seeing quite significant cancellations start to come into play, 50 cargoes cancelled. This year, well below that. In fact, Platts have counted 7, but those were really logistical cancellations earlier in the year due to shipping shortages. So we're in a much stronger position now, Q1, as we see growth in the marketplace, and we believe that's structural growth, not just the fact that we've had a cold winter. Peter earlier said that the IEA expects to see 4% LNG growth this year. You have to bear in mind that LNG is a high growth industry. So 3 years before 2020, 19, 18, 17, we actually saw year-on-year growth between 8 and 13%. And actually the average of the five-year average was 8%. So 4% sounds high, but actually it's quite modest in comparison to where we've been. Our view is that actually we'll beat the 4% in terms of volume growth this year, and that we're in a fundamentally tightening part of the cycle as supply growth now starts to slow down. The US chart, as you saw earlier, starts to plateau, and yet we continue to see demand recovery, particularly in Asia. So I'm going to leave you there. I think that's my 10 minutes, and I will hand you back to Dr. Ben-Youssef, and I'm happy to take questions.
Thank you very much, Dr. Volker, for the presentation. And I would like also to thank the 3 distinguished speakers for their presentation. We took us from the new trend in the gas decarbonization to more focus on China for coal demand, and then to the energy market flexibility in the short-term recovery. Again, we have a few minutes for the Q&A, and really I seek the generosity of the chairman to allow us using maybe around 10 minutes from the break to dedicate to the Q&A. We have received also a lot of interaction and questions through the Q&A box. We cannot ask all of them, but I try to summarize. I think, to be fair with the speakers, I will ask 2 questions to each speaker, and I appreciate if the answers would be short due to the time limitation. I will start by Dr. Tatiana Mitrova. You have shown in one of the slides a couple of scenarios from different agencies and companies on the global gas demand. The trends and trajectories of the scenarios are quite different. I may say some of them are the opposite direction. The question is how these different pathways could help decision makers to take decisions they provide this.
Some echo, but yeah. Is it working now properly?
Yeah,
I hope so.
Yeah, I think it's okay.
So, that's a billion-dollar question, actually, and this is really very misleading for not only for the gas companies, but also for the investors who are providing money for these new FIDs. And here, I think we cannot, in the period of energy transition, nobody can provide guaranteed outlooks. Nobody can ensure this or that scenario pathway. This is an imminent part of transition, these risks and this uncertainty. And therefore, it is the risk that companies and investors have to take on their own. But they can mitigate to a certain extent these risks by, first of all, acting in stages, not making really massive investments at once, but rather splitting them in the shorter term stages, which can be better adjusted to the market conditions. And if at a certain stage they feel that the demand is going downwards, they can switch the next stages, let's say, to hydrogen or to ammonia. So that in this way, adapting to the new market reality. But yes, this risk is there and it cannot be completely removed. It could be only slightly.
Thank you very much. And now, as a follow-up of what you have already mentioned, in one of the slides, you have shown many uncertainties related to post-COVID recovery, including decarbonization and market making decision for FIDs. The question is, to what extent those factors will impact the gas supply
mitigated, I'm afraid. The natural gas market has always, and especially LNG market, has always been cyclical. So we had these boom and bust cycles, oversupply, then a period of deficit because the demand growth, it was not smooth, and the supply capacity additions, it was always made in big jumps. So in this respect, it is the feature of the market. But I'm afraid that right now, in the next few years, we will see increasing volatility related to these unbalanced, uncorrelated dynamics of supply and demand, both due to the demand uncertainty, which can provide both sudden reductions and sudden strong growth during the same year, for example, and due to the supply side uncertainties. Again, some of them could come as force majeure, as unexpected. Some of them could be actually related still to COVID influence. But basically, it will be really difficult to avoid price spikes in this short to medium term. And this is something that consumers, I'm afraid, should be prepared for. This is a characteristic of this market. In the longer term, hopefully, that could be smoothened slightly, at least, not completely avoided, but slightly reduced. But again, this is to a certain extent there to stay, I'm afraid. Thank you.
Thank you very much. Now I will move to the question to Mrs. Sarah Liu. She, in fact, the presentation focused more on the demand and the structure for China. The question is, what do you expect on Chinese coal prices for 2021?
Okay, thank you for the question. With China's economy recovering solidly, the coal demand and the supply for 2021 is expected to continue increasing. But just as I mentioned during the presentation, safety and environment inspections, sales quota control, and logistics, as well as the investigation on the coal-related corruption in the major provinces may continue limit the coal supply for 2021. So we expect coal prices to continue the rising trend in 2021, with the overall trend of easy to rise but hard to fall. The price gravity center will continue going up. Considering the new capacity of thermal coal will bring more additional supply, especially in the second half of this year, as well as a small reduction of thermal coal import. And Australian coal absence will be filled by other countries. So we expect the thermal coal price mildly up by 3 to 4% from last year. As for coking coal, considering limited new capacity of hard coking coal, more decline of import, and the replacement difficulty of Australian coal. So we expect coking coal price would have higher rise, estimated up by 10 to 15% from 2020. Thank you.
Thank you. Now talking about the Australian coal, what do you expect on the Chinese coal import for 2021? And when do you think, in fact, Australian coal import ban will be lifted?
Okay, this is a very good question. As in 2020, China imported 304 million tons of coal, up 1.3%. Currently, coal imports from other countries can declare customs. The import restriction on Australian coal is resulted from the political tension between the two countries. Then the solution will also rely on the improvement of political relationship of China and Australia rather than economic means. So far, there is no sign of import ban for Australian coal to be lifted in the short term. We need to, it's very hard to say when will be lifted, but we need to keep close eyes on the change of the situation, whether the country's relationship will, tension will ease some extent. Since the import ban started from the fourth quarter 2020, so the coal import from Australia in last year continued slightly increasing, especially very strong in the first half of last year. But for this year, it slipped to zero up to now, and likely to keep similar situation for quite a long time. The absence of Australian coal can be mostly filled by other countries, especially for thermal coal, but it will still lead coal imports to decrease some extent in 2021, and the coking coal import will be affected more. So we expect total coal import will decrease by 6% to 286 million tons, of which thermal coal imports down 3% and coking coal down 16% from last year. Thank you.
Thank you very much, Mrs. Liu. Now we have the two last questions to Dr. Andrew Walker. You gave a view on the 2021 energy, but we know that the medium term will be discussed in the second session, but we would like in fact to know, how do you see the market in the next few years beyond that? And what do you think are the key factors that will influence the outcome?
Okay, thank you, Dr. Ben-Youssef. When I think about the factors that I watch as I gauge the market looking forward in the next year, the next couple of years, there's three factors that I look at to see how the dials are turned or can be turned. The first is, of course, supply. And I said earlier, we've been through a period where supply has been growing rapidly. We're now into a period where that supply growth is going to slow significantly over the next 4 or 5 years. As Tatiana said, LNG has become cyclical. I've been in the industry longer than her. I can remember when it wasn't cyclical, but it has become very cyclical. So we're going to be in a period where one of those dials is now turned to a position where it's going to indicate market tightening. The other thing I always look at is really winter. The weather, whether we have a mild or a cold winter, sets us up for really whether we're into a loose or tight year. As was said in the presentation earlier, and I think again Tatiana said it, LNG has had 2 quite loose years, 2019, 2020, even before you take into account the impacts of the pandemic. And that was because Asia had 2 very mild winters, 18, 19, 19, 20. We come out of the winter very well stored in terms of storage in Asia, in Europe, and it means that the market's quite loose for that year. Now, we've had a very cold winter in Asia, we've had a very cold winter and spring in Europe. We've run through a lot of the excess inventory that we had stored, and we can expect that second dial also to indicate a tighter year this year and a carry forward that means any fundamental structural tightness will kind of be less likely to show itself in the next few years. The third one is, of course, economic recovery and how that plays through into demand recovery. And that's about the pandemic, recovery from the pandemic, both in terms of vaccines, the virus, but also economic recovery. In LNG, as I said in my presentation, we were seeing good recovery in China. China was the first to start to recover economically and show strong economic growth, but other places towards the end of the year. So actually, we believe not only are we seeing the short-term impacts of a cold winter, but we're also seeing underlying structural recovery there as well, which indicates that the market probably is going to be tighter than most people were gauging as we go through the next midterm. And certainly the expectation was that it was going to directionally tighten as we go through the next few years. But I think we're already kind of ahead of where most commentators expected to be. And to really round out that comment with something that you can kind of take away, if you look at the IEA, their expectation is in most commodities that we've lost a year of growth. We've seen a year's worth of demand destruction in gas, in other commodities. I think in LNG, we will actually find that by the time we get to 21, 22, maybe 23, we'll find that there's been no structural demand growth, that we're back on track to where we thought we were going to be pre-pandemic. So that's my read of the market and really how the market is recovering in terms of LNG and LNG demand growth over the medium term. So I'm a bit more optimistic than the numbers you saw from Peter and the IEA in terms of market looseness. We're going to have a much more balanced market than we've seen recently. 1920 were quite low, prices quite low and quite compressed. We're back to a much more normal market balance as we head into 21, 22.
Thank you very much. And we have now the last question. I expect maybe from you just a short answer due to the time limitation. We saw a record of spot energy prices in Asia this winter. Would you like to comment on that? And can we expect to see similar maybe next winter?
I think 2020 was unprecedented in very many ways. We saw record spot prices in Asia. That's really about the prompt. That's about extreme supply-demand mismatches, creating typical commodity price spikes, short and sharp, very rapid rises. The underlying fundamentals, I think, although you would expect them to, the volatility shows you that the underlying market's tighter. The fact that prices came down so rapidly in terms of Asian spot cargoes, in terms of the Henry Hub market on the US side, shows that actually those were prompt issues. That was very much a short-term supply-demand mismatch. That was the Asian market trying to chase cargoes for prompt delivery when the supply chains are quite lengthy. Mostly gas meets market mismatches, near-term market mismatches through storage in the marketplace. Whether it's pipelines, whether it's ships, there's a time to get that gas to market. The Asian market got caught short by the severity of the winter. Prompt prices spiked. Those prompt prices were for few individual cargoes for buyers that needed those at short notice for particular market positions. I think I would read it that yes, LNG supply demand logistics can reach the outer limit of what it can manage, and you can see price spikes, but actually the underlying flexibility meant that it managed through those price spikes quite quickly. So I think that's a good way to kind of read what we saw. And no, I don't expect to see that again next year. That was very unprecedented. Unless we have a 1 in 50 winter again next year, I don't think we'll see anything like that.
Thank you very much, Dr. Walker. With this, and before we conclude, I would like to highlight 2 takeaways from those presentations. COVID-19 pandemic highly impacted not only the economy, but also energy demand, including coal and gas. And although there are many uncertainties surrounding the containment of the pandemic, the presenters mentioned that coal and gas demand, including LNG, are expected to recover in the near future. With this, please join me to reiterate our thanks to distinguished speakers for their insightful and rich presentations. And I believe that the discussions in this session pave the way for the session 2, in which the medium and long-term gas and coal markets aspects will be discussed. Finally, I would like to thank again our co-organizers, IEA and IEF, for making this event happen, and also for IEA to host the event. Thank you for the chairman for your generosity. And with this, I conclude the session and I yield the floor to the chairman, Mr. Sadamori, please.
Thank you. Thank you, Dr. Ben Youssef, for the excellent moderation. I mean, this session started a bit later, so I think that this was very well managed with great presentations, and we had so much to learn. So thank you as well to the speakers of this great session. And I look forward to the second one. But before doing that, we would like to take kind of the short break. So maybe for 10 minutes. So the next session, session 2, for the medium and long-term developments, this will start at the 10 minutes later. So that's 3:40 here in Paris. So so let's see each other after a short break. But thank you very much for the wonderful session 1. Thank you, Dr. Ben Youssef, again. Thanks.
You are welcome. Thank you.
we would like to start the session 2 on the medium and long-term developments in the gas and coal markets. And this session will be moderated by another long-standing friend of this community. So Dr. Leila Ben Ali. She's now the kind of chief economist of the IEF. So Leila, please, thank you.
Thank you very much, Keisuke. It's indeed a pleasure to see you, and I hope we will be able to see each other in a physical world very, very soon. So we have some time to discuss the long-term and medium-term developments in coal and gas markets. And indeed, thank you very much for the excellent moderation of the first sessions. So Your Excellencies and distinguished guests, we had indeed some interesting messages that transpired during that first session. We had the call for reversal of the coal trajectory. We had potentially a peak demand, a peak gas trajectory before 2030 that was discussed. And I think in the shorter term, we were also intrigued by the unusual dynamics or the 1 in 50 winter that our friend Andrew Walker has highlighted, and the implications that has created in LNG markets. So I think for the second session, there is an underlying question that I think we will debate, is whether gas can still be considered as a transition fuel over the next 10 years or so. There seems to be a consensus, and that was reflected, I think, during the first introductory remarks by our 3 secretary generals and executive directors, that liquids and gases will still feed the majority of final energy used in 2040. And by majority, I mean more than 51%. And of course, we can always differ on the exact percentage depending on the scenario. But if we want to, this is absolutely true, I think, particularly if you want to respect the elements of the UNFCCC and Paris principle of equity and common, but differentiated responsibilities and respective capabilities in light of different national circumstances, as we were reminded by His Excellency Barkindo at the beginning of this meeting. There seems to be an increase in awareness that, as my colleagues at the IEF taught me and continuously remind me, we don't necessarily have to wait for a global price on carbon as the only way to stimulate clean technology investments. But we definitely need guidance on sustainable development mechanisms, on transferable mitigations under the Article 6 of the Paris Agreement. And I think since we talked about the increase in awareness, I think we need to take advantage of this increase in awareness to really fast track what we call at the IEF the overlooked technologies in terms of methane abatement, as Tatiana has reminded us of, hydrogen economy, biomethane, and CCUS, of course, to make gas use compatible with decarbonization. Can carbon price be high enough to incentivize coal to gas switching? And in any case, what would be the technical potential in large consuming countries like India and China, and in hard to abate sectors? So I think in this equation, in this roadmap, and its byproduct, I think trade as a sector, trade will play a critical role. And I think the byproduct of trade in the next 10 years will be cross-border adjustments or similar mechanisms that we will have in the energy sector and beyond. So the commerciality of LNG, as it was highlighted in previous session already, but particularly over the next 10 years, given the restructuring and the transformation of the LNG market, the low number of FIDs that we saw recently, the increasing concentration of supplies among a few low costs, and I like Tatiana's wider definition of low cost suppliers. Thomas from Total will share with us is a key driver in this equation. So in the first session, the first part of this session, I suggest that we look at the long-term outlooks from the IEA and from OPEC, as our friends Peter and Erfan will highlight the uncertainties for these two hydrocarbons, reflecting, of course, today's policies, ambitions, and pathways, consistent potentially with the goals of the Paris Agreement. But we really want them to incorporate the longer-term impacts of the triple crisis that the world continues to fight. A health crisis, of course, but also an economic crisis and potentially a financial crisis. So I will start with Peter Ziniski from the IEA. He's the lead gas analyst of the World Energy Outlook and the International Energy Agency. And he was previously the product manager for WoodMac, European Energy Service, and a policy officer at the European Commission GRC Institute for Energy. Peter is gonna give us his view on the long-term outlook for gas and coal markets. Peter, the floor is yours.
Thank you very much. I hope everyone can hear me. Thank you, Dr. Ben Ali, and thank you very much for the invitation. I'm very pleased to be here today. And I'm just going to take you through very briefly some of the key findings from our recent World Energy Outlook. And maybe that could help to sort of contextualize some of the challenges facing coal and gas over the long-term period. So very much in line with Dr. Ben Ali's opening remarks. And to be honest, we've already seen a little bit in the first session some of the longer-term challenges faced by gas and coal. So I won't dwell on those too much, but it just shows how hard it is to disconnect the sort of short-term considerations of how these fuels are evolving with the more longer-term considerations at play. And what I'll do today is just first take you through where we stand on the emissions picture, and this is really what's driving a lot of the activity around what's happening in, say, LNG markets through rising interest in carbon offsets, or in coal markets. An increasingly large number of countries are thinking through ways to reduce their coal consumption, but also cognizant of the fact that ultimately these fuels have very much in the past and even today underpin the livelihoods and the future prosperity of several countries around the world. So in the World Energy Outlook, we have two main scenarios: the stated policy scenario, which kind of holds up a mirror to governments around the world based on their intended policy targets and ambitions. And we look at where emissions are heading if all those targets are met and those ambitions fulfilled. So as you can see here in the stated policy scenario, emissions have taken quite a severe drop in 2020, as we already discussed, a 6% decrease in emissions in 2020 due to the economic shock and the lockdowns imposed from the pandemic. And just recently, through our global energy review, we see that rebound in CO2 emissions coming in quite strongly. The executive director mentioned earlier the 1.5 billion tons of anticipated growth in CO2 emissions this year, really enough to offset around 80% of the decline from last year's drop in emissions. Now, what the trajectory, our second scenario is the sustainable development scenario, and that kind of works backwards to meet the goals of the Paris Agreement to keep global average temperature rises to well below 2 degrees Celsius, but also meets a number of other energy-related sustainable development goals, like ensuring universal energy access and mitigating the impacts of air pollution on human health. And so in this scenario, we see that we're on course for net zero emissions globally by 2070. Now, clearly, a lot of countries have accelerated ambitions in the SDS and reached those milestones sooner. And there are other economies that do it later. But on the whole, in aggregate, that's the trajectory that the SDS takes us on. Now, putting this into context, into where we stand today, with a number of countries thinking through and announcing net zero targets. Now, the reason these aren't incorporated in the STEP scenario just yet is because there's not a high degree of visibility on the implementation path for these net zero targets. But if we plot them onto this graph, onto this trajectory, we see that already something around sort of 60 or 70% of today's emissions are covered by net zero ambitions, and that really by 2050, the net zero ambitions that are already been announced take us more than halfway between the gap between the stated policies and where we need to get to align with the Paris Agreement. But that really leaves a huge amount of additional effort that's required across the board. And that includes not just accelerating clean energy transitions domestically, but also putting together enduring partnerships and support mechanisms that can diffuse clean energy transitions globally to other markets and developing economies that need the resources and the incentives to invest in what could be potentially more expensive or more complicated clean energy technologies for their development plans. Now, we also, in the World Energy Outlook 2020, explored what it would take to reach net zero by 2050. You'll have heard in the first session that there's already a full roadmap planned, which we'll release on the 18th of May, which goes into detail about what path, about what actions have to be taken, especially in the decade ahead, to ensure that globally we can reach net zero by 2050, which would be aligned with the 1.5 degree scenario. So much more challenging and ambitious target for the world to get there by 2050. And this is the context where we find ourselves today. Clearly a huge jumping off point to get to where we need to be in the next few decades. What does that mean for fuels? So in our stated policy scenario, you'll see that there really is no peak in global oil demand. Natural gas continues to grow very strongly as well, a 30% rise, which is mostly concentrated in Asian markets, as we discussed earlier in these sessions, and really a sort of flat trajectory for coal demand, which starts to register a decline from about the 2030s. But you'll see that actually in the SDS, there's a huge change in that trajectory. Dr. Mitrova earlier, gave us that nice overview of all the uncertainty here. And indeed, there's a great amount of uncertainty for natural gas. In previous World Energy Outlooks, in the World Energy Outlook 2019, what we call the pre-crisis scenario, natural gas in the SDS did not peak until 2030. We now have that loaded back to 2025, sort of the mid-2020s is when we see a peak in gas demand in the SDS. So really the runway for natural gas or unabated natural gas to play a role is very much shortening as a lot of the advanced economies start to think through and move away from natural gas in the building sector in particular, but also in power generation as renewables and efficiency take hold. So we'll explore those dynamics in a bit more depth for both coal and oil. So for coal demand, one of the key sort of aspects to reducing the emissions from coal and also just reducing the negative air quality impacts. In the STEP scenario, as I said earlier, we see very much a plateau in coal demand. But to take us to the SDS, there really needs to be a concerted effort across the board, but particularly in power generation, especially in the early days of the transition to move away from coal-fired power. Now, that's obviously easier said than done, and there's a lot of different aspects to this. In the World Energy Outlook, we've focused on the sort of 3 R's, repurposing, retiring, or retrofitting coal assets in order to make to conform to a clean energy pathway. Now, what that involves, as was mentioned earlier as well, is to set coal assets on to a pathway that's consistent with the Paris Agreement by, for example, co-firing power plants with biomass or other low carbon fuels, to also put together a retirement plan with accelerated capital depreciation of assets. This is especially relevant for a lot of emerging Asian markets that have only just sort of developed and commissioned their coal assets. Clearly, there's a long pipeline of planned coal power plants, which in the SDS would not necessarily go ahead. So there'd have to be a capital reallocation towards clean energy technologies. Now, clearly that throws up quite a few challenges as you move away from sort of thermal baseload to more intermittent renewable energy, and how you manage that shift really depends on individual circumstances across different regions. But as you see here quite clearly, the move towards moving away from initially the less efficient subcritical units of coal, that's very much front-loaded in the first sort of decade. And then there's avoided investment in even the more efficient coal-fired power plants, such as ultra-supercritical, even though they do have a benefit over using subcritical technology. There's by that point in the SDS, costs have come down considerably for renewables. Battery storage starts to make inroads, and there's less and less need for new investments in coal-fired capacity. Now, moving ahead towards natural gas, there's still an open question in a lot of contexts about whether gas can still be seen as a transition fuel. I think there is a consensus around the room that it does play a vital role. It's the least carbon emissions intensive fossil fuel. But that said, there's a few firsts in the World Energy Outlook series where we've identified that actually in advanced economies, gas no longer grows. So in the past, we've had it grow moderately, mainly driven by shale gas revolution in the United States and other developments elsewhere. But actually in advanced economies now, we don't see any additional room for growth in natural gas demand. And actually it's about 50 BCM lower by 2040. But that said, most of the growth is driven by Asia, China, and India in particular. These markets, double or triple the share of natural gas in their energy mix, albeit from a low base. But that really allows them to get ahead of coal in a lot of respects and to improve air quality. And that's been a real driver of switching programs in China and also a driver of growth in India, especially as India sort of capitalizes on the growing commoditization of LNG and is able to sort of pursue favorable long-term contracts, which is very important from a price sensitivity point of view for India. What happens in the SDS is that actually we see demand, as I said earlier, peak before 2030, and by 2040 it's down by about 500 BCM. Now, a lot of the drivers for that is huge increases in efficiency in the end use and a massive switching away from natural gas, particularly in the power sector, in favor of renewables. There's only modest increases for gas as economies move away from coal and oil. And most of the market growth is in fact in the SDS covered by CCUS. So there's less sort of room for unabated pure market growth for natural gas in the SDS scenario. So what does this mean in practice in terms of the emissions intensity of natural gas? So what we see is that the clearest opportunity, and maybe one that Dr. Mitrova also mentioned, one of the clearest opportunities here is to reduce methane emissions along the natural gas and also the oil supply chains. So in our assessments, we follow this through the IEA's methane tracker. There was something like 70 million tons of methane emissions just from oil and gas operations in 2020. Now that's a huge amount of emissions, equivalent to about what the EU as a whole emits per year in sort of carbon dioxide equivalent terms. And so one of the things the industry can do very quickly and hopefully very efficiently and cost effectively is to reduce methane emissions through a number of leak detection and repair programs, and also just developing the sort of monitoring tools, and the surveys and both the bottom up measurement as well as the top down sort of satellite measurements, which are increasingly common to locate those leaks and to deal with them. Now, the majority of these leaks happen in the upstream. There's flaring, there's venting of gas, and it's not a problem that's sort of unique to any one region. In fact, in the United States, there's quite considerable flaring of natural gas. And so seeing that come down over the next decade, often at no net cost, monetize the gas that you capture, especially when prices are higher, and we've seen them recover, is one route to reducing emissions very quickly and effectively. After 2030, there's a lot of groundwork laid in over the next decade to invest in hydrogen, in biomethane, and CCUS. So these technologies and supply sources become much more prominent in the sustainable development scenario, such that by 2040, the overall emissions intensity of gas as a whole, so we've moved past natural gas and are thinking now more widely about gas and gaseous fuels, falls down to sort of 60% of what it is today. And that's really driven in the 2030s by CCUS, but also low carbon hydrogen. There's something like 90 million tons of hydrogen produced today, but it's very emissions intensive hydrogen. And in the SDS, through electrolysis, but also through CCUS with steam methane reformation, you see a huge uptick in the amount of low carbon hydrogen produced across for a number of sort of industrial uses initially, but then sort of expanding outward to include transport, heavy duty transport, and other so-called hard to abate sectors. So that's the sort of overview, and I tried to keep it as brief as I can, but happy to take questions after. Back to you, Dr. Ben Ali. Thank you very much.
Thank you very much, Peter. And I have so many questions about the low-hanging fruits that seem to be around methane reductions and the combination of top-down and bottom-up approaches. I'm not sure about the easy monetization of the gas, though, but we can debate that during the Q&As. I think now it's time to move to OPEC and Dr. Irfan Favey-Fard, who is the chapter coordinator and primary author of Energy Demand chapter of OPEC World Oil Outlook, which is, as we all know, a yearly flagship publication of OPEC. Prior to joining OPEC in 2014, Irfan served at the Institute of International Energy Studies and at the Research Institute for Energy Management and Planning, as well as Total. Irfan, the floor is yours. You have 10 minutes as well. Thank you.
Good afternoon. Thank you, Dr. Ben Ali, and I would like also to thank my colleagues in IEA and also IEF for this collaborative work and opportunity for this presentation also. I would like to highlight some of our key findings from the latest edition of OPEC World Oil Outlook in the area of gas and coal prospects. We will, first of all, just to make sure, because I asked IEA kindly to take the lead for driving the slides. Is that right? Because I cannot see. Yes. Okay, perfect. So the next slide, please. Okay, next slide. The key parts of my presentation includes, and if you go to next slide. Yep, the assumptions which based on those our outlook is created this year, the last year, the 2020, and also an overview on the global energy demand. We then talk about the gas and coal itself, the outlook, and also trends in the power sector for these two fields. Then I will conclude, hopefully briefly, with the key takeaways. The next slide, looking at the key assumptions which we took into consideration during the time that the outlook was published. We considered the global GDP to recover from the COVID-19 crisis in a medium term, but in long term, the average of the growth will be considered as slower. The global population was projected to increase from 7.7 to around 9.5 billion in 2045, and approximately 96% of this growth is now foreseen to be in non-OECD countries. The global GDP is expected to increase by around 3% on average between the 2019 and 2045, which is the time horizon of our outlook. And most of this GDP growth will be driven by non-OECD. India is also expected to remain the fastest growing country, developing country, with the average GDP growth of 5.6% per year. And China, which its economy is growing to be, is moving to be more matured, we expect that the growth rate to decelerate to around 2.8% per year. And looking at the GDP growth in OECD is also estimated to be around 1.6%. Next slide, please. Our outlook assumes in general an evolutionary development of existing energy policies and also the technology. We consider the key energy-related policies initiatives into the consideration in major regions and countries, and also an evolutionary extension for the fuel efficiency standards. We assume internal combustion engines to remain the dominant for the foreseeable future, and also shared mobility to grow swiftly, especially in urban areas. We consider the potential of hydrogen being explored also to meet the environmental policy objectives. And of course, due to this effect of COVID-19, we assume the remote working to continue to develop. Continued energy efficiency gains is also considered across all sectors, as well as IATA, ICAO, and IMO policy initiatives for aviation and marine transport. Next slide, please. In general, we assume the global energy demand to increase. I mean, we forecast to increase by around 72 million barrels within this period to reach 361 million barrels of oil equivalent per day by 2045. This is approximately, I mean, a bit less than 1% growth per year. We will see the oil to stay the largest with the largest market share in 2045. Also its share will decline, and demand in non-OECD countries will increase by around 76 million barrels, while this will be dropped in OECD by around 5 million barrels within this period. Next slide, please. Looking at primary energy demand growth between 2019 and 2045, we project renewables to expand the most in long term, followed by gas as the second fastest growing type of energy. And the coal would be the only fuel which records a decline in this forecast period. And this would be with a negative growth rate of around 0.3% on average. When we call it other renewables, it means that any source of renewable fuels rather than hydro and biomass, which is considered separately in our outlook, but in general, they will be all the fastest growing fuel, other renewables as well itself. The next slide, please. Looking at the coal and gas outlook specifically, in the next slide, you see the coal demand is expected, maybe in the next slide. Yes, the coal demand is expected to shrink by around 6 million barrels of oil equivalent per day in this period. And in India, this is expected to grow in this time horizon at a pace of around 2.6%. This will be double in the absolute term if we consider. Coal demand also is seen to fall in the OECD America, OECD Europe, and also OECD Asia Oceania. And the share of coal in the overall energy demand will drop to around 20%. For China, it will be minus 0.6%. For India, we expect 2.6% of growth, as mentioned. And of course, in India, the growth that we expect is due to the significant coal demand growth driven by the strong power demand growth in this in this country, and that will double the demand for coal in this period. However, we know that the other renewables, nuclear, and development of the gas will also put some pressure on the coal's contribution, maybe not to increase as much as this is now. So a decline in North America and also EU is considerably forecasted. So the next slide, we look at the gas. Natural gas would be the only fossil fuel in this period for which the demand will increase in all OECD countries as well. So in the medium term to long term, the global gas demand is expected to continue increasing in line with rising levels of urbanization and gasification. Also, industrial demand will increase, as well as this competitiveness against coal for gas, which is happening in power generation mix. So we expect the share of natural gas in the energy mix to double in India and also to increase by 50% in China. However, we know that in several countries and regions, they are increasingly exploring alternative options, which may replace a portion of this forecasted gas demand. This is predominantly green gases, such as also bioethanol or green hydrogen or blue hydrogen, which could take a part of share of gas market in the long term. However, this is largely also dependent to the governmental supports, including providing infrastructures, investments, and also we know the rising share of renewables, especially solar and wind in the power mix, that could also have a negative impact on the role of gas in the power generation within the long term, especially maybe also a little in the medium term. So the next slide, and the next one, we look at the trends in the power sector for the gas and coal. Just to have an idea to compare the role of gas and also other renewables, we expect gas and other renewables projects both to increase the share in the electricity mix. For other renewables, mostly wind and solar, we expect around 9 petawatt-hour of generation in the long term to be added. And for the gas, this number would be around 6. And for the coal, we will see that there would be only a limited increase in the power sector. Of course, with the number of countries that are putting pressure and efforts on decommissioning the old power plants in the country. So this is the main part. I mean, next slide would be just a brief summary of what I mentioned. If we go to the next slide, yes. The global energy demand, as I mentioned, is projected to increase by around 72 million barrels to reach 361 million barrels of oil equivalent per day by 2045. China and India will lead this demand growth, combined increase of 36 million barrels. We expect gas to increase to experience the second most incremental growth in the long term by 24 million barrels, and the share of natural gas energy mix is expected to be double in India and also to be increased by 50% in China itself. Coal demand is also seen falling in both OECD America and OECD Europe, and even in OECD Asia. And we also expect that gas-fired generation will rise by around 6 petawatt-hour, while the coal will see only a limited increase in this power generation. With this, I conclude my presentation, and I thank you so much for your attention.
Thank you very much, Irfan. I think you both agree on the diminishing role of coal, but there's definitely some enthusiasm on gas, indeed, that I think we definitely need to discuss during the Q&A session. I think it's a good time to remind the audience that you can put your questions in the Q&A feature of the Zoom chat. I think we already have one from our friend Pedro Merino, who is asking, and I think it's a very interesting question. Except if you look at the timeline that the IEA and OPEC has shown us, I mean, there are, except for methane reduction, the only other driver that we see to be more effective from 2030 are technologies that are technologically in development phase. And I think he was also including CCUS in it. And we can, I would add into Pedro's question, do you also see, in addition to the technology risk and the development phase that we are having in these technologies, also the financing risk that these technologies are facing? So I think we can start with Peter before turning to Irfan.
Yes, it's a great question indeed, and it's something that we're working on. Actually, the IEA is going to be releasing a clean energy transitions financing report, which explores exactly these issues. A lot of these technologies that we rely on to get us to a low carbon system are very much at the low level of technological maturity, and that throws all kinds of challenges up for financing. But they're not sort of insurmountable in our view. There's a lot of instruments that governments are contemplating to think through how to sort of galvanize private investment and to get them through into these sort of large scale, very capital intensive projects. Because in a way, I mean, you know, a hydrogen based economy or a CCUS project, these are counted in sort of billions and billions of dollars, and how to incentivize those, particularly, you know, in producer economies and exporting economies that would otherwise see, you know, a fall in revenue in the sustainable development scenario from oil and gas sales. How are they going to finance all this? So that's a question that we pose in this report, and we have a number of sort of propositions, and we explore some of the sort of emerging things like transition bonds, green bonds, you know, incentivizing the closing of the gap with green premium. So, for example, in the case of hydrogen, which is very, very much relevant for a lot of parts of the natural gas industry, because, you know, capital intensive projects like LNG historically have relied on project finance, you know, and that kind of model is quite amenable to a hydrogen project in a lot of respects. But, you know, this initial push to get to that stage where, you know, investors are comfortable with the risk, you know, especially because there's no merchant market for hydrogen as we speak today, you know, getting to that phase will really require public support and government support. And really that's what underpins the initial push to get these technologies into that sort of viable space where they can be commercialized.
Okay, Irfan, do you have some thoughts on that? You're on mute.
First of all, I'm of course supporting what Peter mentioned. They are very true and clear. On the top of public supports, governmental supports, and also financial supports, which we need from both private and public sectors, we have to still, I think, wait for the consequence of COVID-19 to be clear on the economy of the countries and also private and public sectors to see how they manage to finance technological advancements, and also how the countries will support policies, because they are interrelated at some point. Sometimes the energy security and issues of the governments may prevent them from supporting the plans which they already had in hand to develop technologies or to switch from one to another fuel. So this energy transition might be projected to be faster in some other references, but this needs to be supported by even falling cost of renewables. That's important, that is happening, but further some massive, I would say massive infrastructural needs are important to be considered, to be recognized, and crucial technological prerequisites such as energy storage also are to be considered for a good and a fast energy transition. That's all I think are important to be considered.
Sure, and I think I would like to, in the framework of the same question, and I will ask the speakers of the next session the same question. There seems to be a tendency to go for smaller, modular. That's relevant definitely in the nuclear industry, in hydrogen. It's easier to finance small scale. True, but at the same time, given the scale of what we're facing and the need for economies of scale, because this industry has lived on economies of scale for such a long time, and we definitely want to continue to provide low cost and affordable energy to all. Where do you see these trends over the next in the long term, in the medium to long term, since we are talking about the long term here?
Yeah, that's again an excellent question, and it's something that we think about often when we think about the investment requirements to get us onto the SDS trajectory. So clearly, I mean, different technologies have different sort of scalability issues, and if you think again on the hydrogen example, you could build in modular electrolyzers, and the market has been compared to solar, where you can build panels and really bring it down to sort of a manufacturing approach. And likewise, the same thing has been thought about for LNG as well. Like modular additions of trains as well. So it's not just clean energy where these kinds of trends are being thought about. But from our perspective, there's certainly a need to scale up, from the megawatts and the kilowatts that we have today to the sort of gigawatt scale projects to see any kind of hope or chance of meeting international climate targets. And so what that requires is a lot of people in the same room. So if you think about what it takes to get an LNG project off the ground, you have sort of 10, 15 banks. You've got, 4 or 5 project sponsors, you've got host governments, you've got the regulators, all sort of thinking and thinking through the same sort of financing challenges and on the ground challenges. And all of this is project specific, right? We track hydrogen projects around the world, CCUS projects, and they're all different by virtue of their financing, by virtue of their scale, and so on. And so it's not a one size fits all approach to how to get these projects off the ground. Circumstances will inevitably vary, but we do need to see that kind of scale up and to see it demonstrated at scale in order to sort of see a pathway through to that sort of growth that you saw earlier in those slides.
Yeah, Irfan, there is a question in the chat, and I think you might be well positioned to answer it, since it's definitely contrasting Europe and non-EU countries. And I think the person wanted to talk about also non-OECD countries in general who do not have national emission reduction commitments. And he or she would like to know if we will see a gas demand shift from EU to other countries. And I'm assuming we're here talking about non-OECD in the future.
Well, it could happen because, I mean, again, it all depends to how countries will be able to manage this crisis. Especially, we expect a huge demand from India, as mentioned before, and we still are not very clear on how the crisis will be managed in this country within the, medium term even. And the consequences on this, it can impact the policy of every country at such a scale to either switch back to using very easy access sources like coal, for example, in this area, or to continue development of the cleaner ones like the gas and renewables and nuclear or whatever. We know also there are some technological dependence between the countries. Some of them are, for example, India is very dependent to China in some of the, in supply of some power plants and materials and infrastructures, and this also is impacted at this moment. But in general, we can say yes, a shift for the gas consumption can be assumed from OECD to non-OECD countries. But should also consider that still the gas is the only fossil fuel that is also growing in OECD. So this is not like that there is going to be a decline, at least in our projected time horizon. But for sure, the increase and the growth rate in non-OECD will be much higher. So that's something which is clear from now.
Excellent. And I think the questions actually on the chat I'll put them under the family of stranded assets and ESG concerns. Basically on the role of natural gas as a bridge fuel to a low carbon future might be undercut. Coal, we have already talked a lot about the future of coal in the next 10 to 20 years. But the two persons are already asking about what we see the impact over the next 10 to 20 years on, well, natural gas infrastructure investments and more widely stranded assets in gas and coal. Maybe you can start, Peter, and Irfan can continue on that.
Yeah, that's again another theme that we're looking at in quite some depth for the upcoming report. And so one of the things we're interested in is learning, you know, the recently under construction LNG projects, you know, normally they get stress tested before they get financed. And the stress tests are usually commodity price risk. You know, obviously if prices go down to what we saw last summer, it's not easy to recover your invested capital in that large scale project. But then there's also the risk that some of these assets might have reduced utilization over time if countries are serious about net zero targets. So something like 60-70% of LNG demand comes from countries that have net zero targets. So, you know, how is the balance going to be struck with managing these contracts and these assets? And so most LNG projects, you know, have a economic lifetime of sort of 30 years or so. So, you know, we're still in that horizon where there's a payoff period, you know, and the debt tenure is typically 8-10 years as well. So you'll see that getting paid off. But, you know, the stranded asset, the NPV of those projects that have recently come online, you know, are at risk if there's an accelerated ambition, you know, globally to reach, say, net zero by 2050, or for several markets, you know, to start phasing out natural gas. And I think the other thing to say on that is that, you know, when we're assessing the natural gas in general, we disaggregate the value chain more and more often these days. You know, we think to ourselves, you know, what's the impact on LNG? What's the impact on sort of conventional domestic natural gas? But then, you know, where can the gas infrastructure be leveraged, you know, to accommodate low carbon gases, biomethane, hydrogen? Where can CCUS play a role, and so on? So we increasingly do that to consider, you know, what the sort of risks to stranded assets are, you know, by the part of the value chain that we're looking at. So that again is something, you know, that's very much a consideration in these scenarios.
Right, Irfan, do you have any strong views on stranded assets?
I mean, usually Peter doesn't leave anything for me to comment on. He just gave a very general and comprehensive view on every question. So not much to add, as again supporting what Peter mentioned, and I think we anyway expecting a bigger role for the gas. But in general, we at OPEC believe that all sources of energy are needed for a sustainable future, and we think gas is also a key player in this game. So not anything extra to this.
Okay. Well, I mean, I would like to move to the second half of this session, but maybe one last question to both of you. And I know when we were preparing for this session, you told me that you can be asked anything. So, and that was part of the list on carbon pricing. What is the position of OPEC and IEA in your outlooks on carbon pricing, and what sort of assumptions did you have underpinning your outlooks? Who would like to start?
Maybe I can give this one to Irfan first.
I mean, we assume, of course, the current considerable policies for carbon pricing in EU and outside of OECD countries. I think it is easy in general. Of course, it will impact the consumption of the fossil fuels. It will mainly hit the coal, we believe, and I think that's already running some of the investments out of the market for the coal, and the impact on the gas will also be important. But I think at the same time, we considered OECD countries also are still a main consumer of the gas, and that's something which we should consider. Any kind of carbon pricing, which is a harsh decision, may also impact these countries as well, because they are, anyway, some of them are switching now from coal to other sources, and gas is a good option for them. So carbon pricing is a key will be a key game changer. But we think to some extent this will mainly hit the coal, and also the oil in the next stage might be also considered as fuel. But again, I think this is not something which be making a revolution in the maybe very short term or even in the medium term. But in the long term, this can change the policies and infrastructures in some part of the world still. Yeah.
Interesting. How about you, Peter?
Not much to add, in fact, but just to say that indeed carbon pricing is a very important element of the shift to clean energy. You know, as we've seen already today, you know, a lot of these technologies are early stages. You know, adding a carbon price can really start to sort of give clear market signals to investors. You know, that there's an incentive there to invest in lower carbon technologies and to actually, you know, make some money out of it, which, you know, as Tatiana said, isn't the case today. So certainly it's a crucial element, but it's not the only element. And there's clearly a lot more. There's a whole suite of policy tools and regulatory options for countries who want to support, you know, clean energy investments and may not sort of think that carbon pricing is the right solution for them. And that's why, you know, at the IEA, we you know, when we think about through these things, we think about them at country level and at sector level to really understand what the drivers and the impacts could be. So that's reflected in our scenario. And there are assumptions that you can see online about where we see carbon pricing heading. So I'd encourage anyone to look that up if they're more interested in that. Thanks.
Thank you very much, Peter and Irfan, and I hope you will stay with us and feel free to make any additional comments on the next session, because we will definitely now go around the world, and we will be more focused on the vision for coal in India that Dr. Anil Kumar Jain from the Ministry of Coal of the Government of India will share with us. We will also look into the dynamics in the multifaceted European market and the Chinese economic ambitions that my friend Dr. Carol Nachle is going to talk about. And also, I think Thomas from Total is going to present to us some slides on the commerciality of LNG to really complement what has been said in the first half of this session, of this webinar. So I think I would like to give the floor to Dr. Anil Kumar Jain, who has over 3 decades of experience in field and policy formulation levels, primarily in India, and has held senior positions in the central and state governments in multiple ministries, including environment, including the Planning Commission, and petroleum and natural gas is an area where he specializes. Dr. Anil, the floor is yours to tell us about what is happening in India, particularly when it comes to your coal perspectives. Thank you.
Thank you, Dr. Ben Ali. Can you see my screen, please?
Yes, we can see your screen. Thank you.
Thank you. Good evening, friends. Many thanks to the IEA for inviting me to this symposium in this very important topic, India's coal perspectives. I will be basically contextualizing coal against the background of India's energy imperatives. We have heard very wise presentations from our friends from OPEC and IEF, and OPEC presentation dwelled a lot on the likely growth of energy parameters in India. So very consistent with that, might I say that India is a growing economy, and it might register the highest growth rate this fiscal, and similarly very robust growth rates in the coming years. And that will kind of be the background against which coal and all other fuels will play their role. So the first slide, generally it is known that India is an economy which is full of potential and waiting to expand and achieve its real status. So this slide kind of puts us into the perspective that India's electricity consumption per capita is very much on the lower side. For some years, we have been trailing in electrifying all the homes, which we have very recently achieved near 100%. And that is the background against which, electricity consumption is going to grow. And in terms of fossil fuel, which we have a historical, background, just like any other economy, where the power sector grew on the shoulders of coal, and then later on, other fuels got in. So this slide basically tells us that India not only needs to substitute, fossil fuel with clean fuels, but it also needs to add. So when you add, then you need everything. So this is the background where I come from. In this slide, you get an idea that India's electricity, where it's getting consumed. When I compare it with some of the larger economies of the world, let's say the US, or for that matter, the China, you find a lot of variance. In China, a larger share than what we see in India goes into industry, whereas in the US, a very large share of electricity goes into domestic sector. So India, kind of lies in both these outliers. Our industrialization has to pick up. We have a big ambition of growing our manufacturing sector. We want to produce for India. We want to produce for the world. So the share of electricity in manufacturing industry ought to grow. And in the domestic, as I mentioned, that with the recently achieved 100% electrification, the rural areas and the people so far deprived are still going to buy a lot of fridges. They're going to buy microwaves and electrify air conditioners. So that is going to set the background for growth in electricity. We have had, as I mentioned, historical legacy of coal, much dictated by resource endowment. India has very little, India has just 0.6% and 0.4% of the world's resources of gas and oil. On the other hand, India has almost 17% of the world's population. So against that background, coal we have in plenty. We have more than 100 billion tons of proven resources of coal. So that has predicated, the large fossil fuel share. But as you might see that in the last 5 years, there is a change which is afoot, and renewable is making its debut. This slide I wanted to bring in to, coming from the previous slide, that with a large domestic resource endowment, India, it has had some infrastructure bottlenecks, some policy bottlenecks, which resulted in our importing almost $20 billion worth of coal every year. Almost a quarter of our coal demand has been imported. But in the recent years, the policy changes, liberalized policy, improvement in infrastructure has led to a renewed interest in entrepreneurs wanting to open up Indian coal mines. And recently, the bid rounds for coal blocks have been very well received. So that is something which I wanted to put on the table. The sectoral coal consumption so far, of course, is the power sector which has dominated in the coal domain. 70% of India's coal is used for power, and 30% goes into various industries. We all know that renewables are basically catering to the electricity sector. So it's rightfully to say that it is renewable electricity which is rising, and that is making a dent and will make a dent in the coal which goes into the power sector. But it is the coal used as solid fuel which as of now is poised to grow. Even in the IEA's report which they did for India, they have mentioned that India's ambition, where we produce 130 million tons of steel, and we want to go to 300 million tons of steel by 2030. So those processes, our blast furnaces, etc., are still technology is coal dominated. So until the new technology, electricity related technologies, they occupy the manufacturing space, the mining processing space, electricity, renewable will not make a debut in those sectors. So as I mentioned initially, that where we come from, low per capita electricity consumption, India's electricity sector is poised to keep growing. And so we need whatever new sources, be it renewable, be it coal, be it nuclear, to fuel a rising power demand. As we know that in the OECD, and generally the electricity demand has plateaued or it may be falling. But in the case of India, 4.6% CAGR. So electricity sector is poised to keep growing. And that is where, coal needs to play its role until maybe renewable takes over with size and scale. Power sector, we have already mentioned that most of the coal is going into power sector. Last 2 years, the Indian economy has not been in a pink of its health. So we know COVID, and prior to that also a little economic slackening. So the growth which we saw in the earlier 4 years has not been witnessed in these last 2 years. But that is something which is springing back, and I'll just come to that a bit later. Renewables, India has a huge target. At the moment, we are, and let's not forget that in India's primary energy sector, the slides which I presented basically talk of the commercially traded primary energy. We haven't brought in the biomass, which actually is a quarter of India's total energy requirement comes from the renewables, which is the biomass. But we're only talking of, the commercial renewable, which is the solar, wind, small hydropower, large hydro. So with the advent of the renewables, the PLFs of the coal and the lignite sector have been falling. But it is, these PLFs actually come as a comfort to stabilize the grid, should there be an enhancement in electricity demand. Renewables, so we have spoken both for renewables and as well for coal. So sometimes the Indian story, comes out as confusing, but I like what our friend from OPEC had mentioned, that all energy sources will probably be playing an important role in the coming years. India's renewable target has a total of 90 gigawatts, of which solar is 40 gigawatts, aims to go to 450. So this is this is what the paradigm is, that will renewable be able to fuel our rising electricity demand in the coming years is the question. So until that, coal is needed. So as I mentioned in my third bullet, the distribution companies are no longer keen to sign fresh long-term power purchase agreements with coal generators. But on the other hand, the policy framework for renewables is very bright. So by and large, other than the non-power demand in manufacturing and industry, where the processes still are coal friendly, otherwise the parameters are all more in favor of renewables. So towards the end, what messages do I wish to convey? In the medium term, we expect demand to rebound. Last 2 years were difficult years for India, but going to 2030 and beyond that, I wouldn't conjecture, I guess, energy demand is going to rebound. I might mention that in the months of March and April, we have had an unprecedented growth in electricity demand. As we talk in April, the electricity demand is almost 60% over April of last year, which of course was a different time period because we had a complete lockdown. But even in March, when we did not have much of a lockdown last year, as compared to that, this March, the electricity demand was 30% more. So in India, the economy is waiting to really unshackle itself, and that is why it's a difficult nut to really unravel. So the first message is that demand for power has to go up. There's enthusiasm for new coal blocks, and economic reforms are bound to unleash the animal spirits. And in this last slide, what I mentioned is that due to the economics having shifted in favor of renewables, coal demand may rise, but at a tepid rate. New plants are not on the horizon. They're not being approved, but the PLFs, as we saw, of the existing plants, are low and they can bounce back. So renewables will witness an exponential growth, and we expect coal to cooperate with renewables. And as the economy grows in the coming years, we have to see how coal really pans out. So with that, I finish my presentation. Thank you.
Thank you very much, Dr. Anil, for this fascinating presentation where you showed us the dilemma of a large domestic coal mining economy that is being requested to transform. And I think your sentence when you said that India needs to substitute and add is very much telling of the challenge that the economy will be facing. I think that I would like to move to the next speaker, who is Mr. Thomas Maurice from Total. He's a Senior Vice President, LNG in GRP, Gas, Renewables and Power Management Committee in Total. Thomas has spent his career in the French Ministry of Economy, Finance and Industry before joining Total and having an impressive career there in 2012, where he held a successive increase in responsibilities, first in refining and chemicals, and then in E&P, in exploration and production. Thomas, the floor is yours, and you can present to us Total's outlook for medium and long-term LNG. Thank you very much.
Thank you very much, Leila. Thank you very much to all. I'm very honored to be there today for this IEF Symposium and to share some views on LNGs and discuss more generally about also natural gas and the energy transition. Maybe next slide. Just as introduction, I want to have a quick look of what happened in 2020 that we all know, and the impact of the COVID crisis on energy. You see on this graph the impact that it had on the world GDP with a decrease of 4%. We see that the global energy demand aligned with the world GDP has decreased by 5%. The oil demand has decreased by almost 10%, mainly due to the stop that we face in the mobility. And maybe what is striking in this slide is that despite those decreases, despite the pandemic, two energy sectors have continued to grow. The LNG sector with a growth of 2%, and the electricity from renewables, wind and solar, by more than 10%. And it shows that LNG and renewables are the key contributors to the energy transition, and that also explain why Total is now embarking into a big transformation and transforming itself into Total Energies, a broad energy companies with pillars on natural gas and renewables. Next slide. This slide gives you few figures on LNG in 2019 and few facts that happened that year. So you see that in 2019, the LNG trade faced a record growth with almost 12% compared to 2018, almost 40 million tons of new demand in LNG, 21 million tons of new LNG plants were commissioned. The US and Russia became top 3 and top 4 LNG exporters, showing also new actors in those LNG panorama. And that year also was very amazing with a record of FID, which were taken with 5 projects accounting for 63 million tons. 2020 was a little bit nuanced, let's say, due to the pandemic. But though, as already said, the growth in LNG were still there with 2% growth. 20 million tons of LNG plants were commissioned in 2020. The US had 11 million tons in the output growth, Qatar 2 million tons, and Russia 1 million tons. less FID were taken, with one in Nigeria Train 7, and one in Mexico, Energía Costa Azul. By the way, Total is part of those projects. Maybe on the left side, what I want to highlight is the new supplies by country. We see that LNG is a worldwide industry dominated by Qatar, which is now the top one supplier worldwide, followed by Australia, and as already said, the two giants now there in LNG, US and Russia. Next slide, please, Leila. This one, I will go maybe quickly because it was already described and very well described by the IEA and the OPEC. This slide shows the growth in gas, and that the gas will become the second-ranked source of energy globally. These graphs are comparing 2019, so now, and the long-term horizon 2050. And we see that in all the scenarios, the SDS, also what we call the total energy outlook momentum scenario, which is aligned with the state policy scenarios, or what we call the rupture scenario, where we have to take more rupture in innovations in the policies from the state to really continue and achieve the targets for the climate, to fight the climate and global warming. But natural gas keep a very big part in the energy mix, with almost 23% today, and continuing to grow by 27% in the momentum scenario, or 25% in the rupture scenario. Also, of course, what is striking there, it's the growth of renewables, which take a big part in the energy mix. On the right side of this graph, few indicators to show that the growth in gas will be driven mainly by the power generation, also the industrial and residential sectors. What is new maybe, and we see that also in LNG, the transportation is a big driver for the growth, with new mobility and also gas for bunkering. On the bottom right, sorry, just this graph highlights the split per region, and as it was already said, the big contributor for the gas demand growth is in Asia. Next slide, please. So, what are the advantages of natural gas? Well, natural gas it's an available and reliable energy, which will allow us to meet the growing demand. Also, it's an affordable energy, and it's very important to say when we speak about the energy transition, and our duty also to be able to supply energy for a growing demand. I will come back to the second advantage, but of course, it's the fossil fuel with the lowest greenhouse gas emissions. And so it's a key energy resource for the fast climate actions that we want collectively to take. And then the gas offers considerable flexibilities for both transportation and use, and especially when it's liquefied, because it allows, of course, to transport the gas from the production basins to the consumption basins. The next slide make a focus maybe of why the gas is central to the energy transition. And we highlight here maybe two main topics. The first, that once again, it's key to curb the greenhouse gas emissions and improve the air quality. The natural gas emits 50% less GHG in the electrical generations compared to coal, and almost no air pollutants or fine particulate matter. So it's very important. I think it's important when we are speaking about how to decarbonize the world, that replacing coal in the power generation will reduce the emissions by almost 5 billion tons equivalent per year. Natural gas has been recognized as an important energy into the energy transition, and we see more and more policies integrated gas as a key in the energy transition, and also important to the new usage into the mobility, and in particular in marine fuel. On the second topics, what is key is to understand that gas is the perfect complementary energies to the intermittency of the renewables. And so it's an abundant and available resource which can complement the use of renewables, and which can also lead to more flexibility, more stability in the energy systems. Next slide. Maybe in natural gas, what is growing is really LNG, because LNG has some advantages. It's a quick way to address what we see in some countries, which is the declining domestic natural gas production. And so to complement and substitute domestic production with imported gas. It's also a good alternative to the gas pipelines. We see that in in Europe. We see that, of course, in China. As already said, it's a more environmentally friendly source of energy, and so an ideal partner for the renewables. And last but not least, we may come back to this. It's more and more affordable, with large scale effects that we have achieved, that the industry have achieved by developing new projects, new liquefaction projects. We were speaking earlier about modular projects. All the efforts that the industry has made has succeeded to make the LNG more affordable. So,
sorry, Thomas, I hate to interrupt. You have 3 very interesting slides that are coming at the end, and 3 more minutes, I'm afraid, to finish your presentation.
Okay.
So if you can accelerate. I think your last 3 slides are very interesting, and I want to give you enough time for those.
Just very quickly, the next slide. The next slide is to say that the LNG will continue to grow by almost 5% per year in the next decade. And once again, mainly in India and in China. And the last one, maybe the next slide. This one is to give the panorama of the projects that are still in the pipe. The LNG today in 2020 is around 380 million tons per annum, and we should reach by 2030 600 million tons per annum, with 100 million tons of new projects which have already taken their FID, and also 100 million tons which are in the pipe, which have been delayed due to the crisis, but which will come also into stream. So I stop there, and I will be happy to discuss during the discussion.
Thank you very much, Thomas. I mean, that's the slide that I really wanted to show in the presentation. I remember the days when we had the cost of liquefaction around $400 per ton per year of capacity, and then it boomed to more than $1,000 per ton per year. So we can definitely discuss the cost and the financing questions during the Q&As. I would like to turn now the floor to our last speaker, last but not least, of course, our dear friend, Dr. Carole Nachle, who is the founder and CEO of Crystal Energy, awarded Best Independent Energy Consultancy in the UK in 2018. And I've never congratulated you for that, Carole, so congratulations. Thank you. Carole is, of course, a recognized authority on global energy issues, and very well known in the energy industry. She worked for ENI, Statoil, for governments, for policymakers, and international organizations and specialized think tanks. And she also lectures at Oxford University and University of Surrey. And Carole is going to discuss the role of gas and coal in energy transitions in the era of net zero. And Carole, you have 10 minutes, please. Thank you.
Thank you very much, Leila. Thank you for having me with you today. I'm going to try to shed perhaps a different angle on, or a complementary angle on what we heard before, because I hear a lot, for example, about the growth of renewable energy, but little is said about at the expense of what. And especially, so if we look at electricity, and this is what I'm going to focus on today in a selected key countries and region, you can see that it's been, and the share of certain fuels have been quite stubborn. So if you look at fossil fuels, if you compare 1985 with 2019, I mean, the share of coal has hardly changed. As you can see, this kind of flat line. Yes, the share of oil has been going down, but it has been captured by natural gas. And the share of renewable has been increasing, but this has come primarily at, maybe they absorbed partly of the oil decline, but it's mainly the decline in nuclear energy and actually a little bit in hydropower. So we have to be very careful when you're talking about a growth in certain fuels and ask ourselves, it's coming at the expense of what other fuel? Because at the end, I mean, they all have to add up to 100% of our primary energy mix. And here in terms of electricity production by fuel. So that's what's important to realize, because that's what something that happened here in Germany where I'm sitting, where they end up replacing green with green and not really green with or fossil fuel with green. So that's one first observation I want to make. And then I'm going to look at certain regions, because when you talk about, first of all, net zero, I spent some time actually, and that would be my next homework. I got quite intrigued after I prepared for this presentation to find one comprehensive universal definition of net zero, and I couldn't find. So for me, it's still work in progress. You find, a bit of differences here and there. I'm going to show you the example, for example, in China, when you read between the lines in terms of their commitment. But also the other thing that we should consider is the energy transitions. That's why there was an S in the title, energy transitions, rather than just one energy transition, because you have different regions and different countries, as you all know, going at different speed. And that might actually be amplified further post-COVID. I'll come back to that point in a minute. But if you look at the electricity generation by fuel type, I mean, mainly the OECD countries, US and the EU as a region, you can see quite diversified energy mix. And perhaps the EU stands out because the EU has perhaps the most aggressive climate change policies. But in the rest of the world, whether in China, maybe to a lesser extent, Africa, but definitely in the Middle East, which really stands out because it is the least diversified region, whether in terms of electricity generation or energy mix. You can see, however, that there is no coal here. It's mainly oil and gas, and China, it's primarily coal, as we heard from previous speakers. Now, I've highlighted, I want to focus on the three regions and countries where you have the highest, who are the main contributors to our to carbon emissions. And I look at the EU as a bloc and the US. So you can see in both cases, the trends have been towards a decline in CO2 emissions. So they have done a great job. But I'm going to show you later that to meet the targets that they are telling us, or they have set, especially, for example, the Biden administration quite recently, they need to triple the efforts that they did since 1990 to achieve those targets. Whereas China, you can see those emissions continue to rise. So let's look first quite rapidly at Europe. So I took Europe because I included the UK, but here the EU plus the UK, you can see that, yes, definitely it's very nicely diversified, and you can see greener energy with nuclear, hydro, and renewable energy. So it's quite, it's playing an important role. However, when you break down that picture by country, you can see really that underneath this trend, there is a multi-speed energy region when it comes to the interplay of fuel. And here for me, two countries stand out, Germany and Poland. And you can see in Poland, the massive dominance of coal in power generation. And the same can be said in Germany, where actually instead of ending up having more renewable energy for power generation, when Germany decided to turn its back on nuclear power, actually that came at the expense of, it did not result with more renewable energy. It resulted actually with more fossil fuel. And just to throw at you one number, if I can remember it correctly, that to get together, Germany and Poland account for more than 60% of coal power generation in the EU. So that's one thing to bear in mind when you talk about the EU and the energy transition in the EU. It's not going at the same speed. Now, if you look at the targets of the EU, that they want to be climate neutral by 2050, you can see that they have achieved a lot since 1990, 23% reductions. But whatever has been accomplished to date has to be done now roughly 3 times faster to achieve that target. Now, in power generation, of course, to lower greenhouse gas emissions, it's no brainer. You have to target coal, which is the dirtiest of fossil fuel. But if you want to replace, I mean, ideally, you would want to replace it with renewable, but we are all aware of the problems related to renewable energy. That is mainly the variability or the variation in the utilization rate, as they depend on primarily on weather condition, at least under today's conditions from a technology and storage perspective. So there is really a great opportunity for natural gas, because not only, as Thomas said, it's much cleaner than coal, and it emits almost more than 40% less carbon dioxide per kilowatt hour, but it can also complement wind and solar. And what I found fascinating, because I always knew that, okay, you need this kind of a backup, but I didn't know that it was literally almost minute-to-minute fluctuations in the output of solar and wind can be met by natural gas. So here I took the, I'm very influenced by Germany because I'm sitting here because of the restrictions on travel in Germany, but you can see the fluctuations in wind and solar. And I took a period where you would expect at least a lot of wind, definitely maybe not a lot of sunshine. And here you can see gas generation. Actually, if you put them together, you can see that whenever the wind was not blowing, natural gas kicked in to support that kind of backup generation. And this is why it leads me to talk about how the energy transition, in my opinion, is not about less integration between fossil fuel and non-fossil fuel. It's more integration, but I don't see the discussion going into that direction, at least not for the foreseeable future. This is not being talked about. So there is a clear case for natural gas to replace coal, and actually we run the number for the EU. And we found that if you go for a complete switch, and by the way, the infrastructure is there in the EU for natural gas, so you're not going to install things from scratch. So that is an opportunity, a golden opportunity in the EU. So if you use that infrastructure fully and you have this complete utilization switch from coal and oil in some places to gas, you would achieve carbon dioxide reduction equivalent to 6 years worth of annual reduction rate of CO2. If you do the same in terms of replacing coal and oil with renewables, then you are looking at almost double that period. So definitely there is a strong case in terms of speed that supports the push for greater use of natural gas in the EU. But I believe that the energy transition in Europe as a whole will be mainly a story about gas and modern renewables. However, that's the climate rationale and maybe the economic rationale to a certain extent, but there is also another side of the story, and the political dimension come into play, and that raises some question marks about the future of natural gas in Europe. Primarily, the pressure in some member states to protect coal mining jobs, especially when coal is in remote areas or disadvantaged regions with long and proud local traditions. The issue of security of supply concerns, where some countries don't want to increase their dependence mainly on Russia, so therefore they would like to stick more to something domestically homegrown and safer. And there is the all-important carbon pricing, which is not high enough to encourage this kind of switching from coal to gas. So there is a strong case for natural gas in Europe, but there is no guarantee that the switch from coal to gas will happen, though I have the feeling that given the aggressive policies in the EU, we might see a stronger push than what I'm trying to convey here, but we should be aware of these kind of question marks and uncertainties. Let me turn quickly to China. And as I said earlier, we have to be aware of the targets announced by different countries around the world, because when you look at these targets, you realize that the way they have been framed make actually comparison between policies and objectives quite difficult, because a small difference in the definition or in the like here I'll show you in the case of China can lead to a different outcome. So for example, we have the Chinese economy, their aim, the Chinese government has revised its commitments and make them tougher. So they want to achieve a 65 reduction in carbon intensity from 2005 levels compared to previously 60% made in 2015. However, so this may seem ambitious, but when you talk about carbon intensity, which is per unit of GDP, so you are depending that on more or less like something like a variable like GDP, then the country is retaining some flexibility. And here is one difference with other countries. For example, many advanced economies have committed to a reduction of carbon emissions in absolute terms. However, with China, by choosing carbon intensity target, this could be actually achieved if GDP slows down. And so in this case, carbon emissions would not be reduced as strongly as you may have thought just by looking at this target on the surface. And if you look at their 5-year plan, the 14th 5-year plan, which was approved last month, it was very interesting to see that they did not really set a numerical GDP growth target, unlike tradition. So this can hint to some perhaps maybe less optimistic future for GDP, and that would translate to a lower than expected carbon emissions target. But there are also other things that caught my attention when I looked at the 14th 5-year plan in China. It had 2 specific targets, energy related, that actually could slow down. It could actually question the growth in natural gas. Now, we are all expecting, because natural gas at the moment plays a very small role in the primary energy mix in China and in the electricity mix. So we are all hoping that there will be great push from to switch from coal to gas in China. But again, there is uncertainty there, partly because of the commitment to increase nuclear power generation. So that will come at the expense of something else, and we're not quite sure what that will be. But second, while they say they want to achieve 20% of primary energy consumption from non-fossil fuel by 2025, they don't actually cap the consumption of coal, which means that that could also come at the expense of natural gas. The other thing that is important to remember about China is that although they introduced carbon pricing mechanism like the trading scheme that you have in the EU, however, I mean, it's still early days, but the prices that we are seeing there are pretty low to incentivize coal to gas switching. And the other thing is that depends, again, there is a big question mark about domestic supply. So if domestic supply in China for gas doesn't pick up, this means that China is going to depend more and more on imports. And we saw in 2020 how China actually became the largest, if I'm not mistaken, LNG importer. And that had implications on prices. So here, if China continues to grow its dependence on import, that would translate into higher gas prices, then that will slower the shift from the more competitive coal to gas. And then finally, there was an interesting study which talked about a technical side, that they say that under existing conditions, the maximum technical potential to switch from coal to gas, at least for the next 5 years in China, is limited to 9% of current coal generation level. So lots of question marks about the future, at least the midterm outlook for natural gas in China, the switching between coal and gas, it may not be as we are hoping for, with implications on the net zero targets, on climate change targets, etc. But
sorry to interrupt. I'll
yes.
have to, if you have only 1 minute left.
Yeah, and I'm concluding. That's not this and this. But anyway, I'm just going to show the U.S. success story. They did pretty great job with the reduction in carbon emissions. And that came primarily because of the increase in renewables, but even more so of natural gas, thanks to the shale revolution. You can see how natural gas squeezed coal in power generation. But I want to highlight one last point, that the Biden administration's new ambitious carbon emissions targets require, like the EU, a tripling of the effort that they have achieved in the since 1990. And that again, but there, I think there is a greater chance for gas, because of pricing mechanism more than anything else, and the domestic production, to make this kind of target achievable. And on that, I thank you very much for listening. I hope I finished on time, Leila.
Thank you very much, Carol, for your patience. I mean, it's always difficult to be the last speaker in such a long symposium. I would like to thank the IEA for being generous with us. And even if we are behind schedule, we are given like 10 minutes for Q&As. And without further ado, I wanted to ask possibly the first question to Thomas. There has been a lot of talk, and there is one slide that I found very interesting that you had to cut at the end of your presentation, showing this increasing market share between, particularly concentrated between the US and Qatar, of course, the lowest cost suppliers in the LNG market. And because there has been a lot of talk about integration between different fuels, I wanted to ask you about partnerships in the LNG industry, and whether you see a future for partnerships, and if you can give us a couple of examples of where actually that could also lead into a decreasing costs in the future of LNG.
Thank you, Leila. That's true that the LNG industry, as it was for the oil industry, is made of partnership. And that's true in the upstream segment, in the liquefaction plants, where we see more and more consortiums to develop new projects. That's the case, for example, for Total in the US, where we have developed project with Sempra, the Cameron LNG project. That's true when Total is participating to the QP projects in Qatar. That's true, for example, when Total is participating to Russian project with Novatek. And I think making partners is a way also to diversify the risks between the shareholders of a project. But what we observed, and what we have also observed, of course, in the past in the oil industry, what is important also to understand that what we are doing is also partnership in the downstream sector. When it comes to penetrating new markets, it's important. When you are investing in a gas to power project, it's also important to invest with a partner to share the risk of this project. Total is doing that. We have done that very recently in India, where we had this chance to establish a very strong partnership with the Adani Group. It has started with an infrastructure project, which should be delivered in 2022 for an LNG terminal, continued by gas distribution and now in renewable. That's true also in China, where Total has created a joint venture to sell its gas downstream, and it's an LNG to downstream gas with a joint venture. And that's also what we try to do in other countries all over the world, in Africa, also in Latin America. So partnership is definitely a very important key to develop our industry.
Indeed, thank you very much. I would like to turn to Dr. Anil, and you had a very intriguing presentation about India, and I think you developed this concept of the just transitions, particularly that you have such a large domestic coal mining economy that is expected to be turned around. What are your thoughts related to that? I mean, what are your actual thoughts, regardless of the scenarios that we presented?
You know, India has almost 150-year-old history with coal mining. It was the Britishers who developed these coal mines and the power plants. And India is a huge country, and coal happens to be found concentrated in eastern India and central India. So you can imagine that over the last 150 years, local townships, local industries, grew centered on coal. So, and coal is a sedimentary deposit which is found horizontally for a very large span. So they are virtually coal towns. So it's nothing strange. I think it's been seen in the US and also in Germany. Now, India taxes coal a hell of a lot. And it taxes, for that matter, even oil a lot. So the local state governments, the local industry, and the workmen, the communities, the transportation network, the railways. In fact, the Indian Railway subsidizes the passenger transport, and it loads a lot of freight charges on the freight sector, and 50% of India's freight is of coal. So you can imagine that when you talk of a just transition, you will be actually involving many stakeholders. So it has to be a gradual process. So when we read in the papers of how Germany is trying to wean away, lignite, or we read about other countries and the kind of endowment which the governments are given in millions of euros and dollars. So for a developing country like India, this has to be very seriously thought through. And so these are larger dimensions of the just transition which I have in mind.
Yeah, thank you very much. I think the next question from the chat is to Carol from our friend Ayaka Jones. I think there is an implicit assumption that Ayaka has that if you take the difference in the challenges between blue hydrogen and coal-based blue hydrogen and gas-based blue hydrogen development, and she's assuming that technology development would ensure largely the same emissions profile for the two pathways. What do you think, given what you've seen in different regions of the world, if you have any thoughts on the key differences in challenges between coal-based blue hydrogen and gas-based blue hydrogen?
Yeah, at the end, it's all going to be to depend on the cost. I know hydrogen is quite popular today, and I don't want to raise any skepticism because I haven't followed the science of it, but the numbers so far don't speak in favor of, let's say, most of the forms of hydrogen. So I will not be able to make assumptions on that in that respect. But we can see that you have the hydrogen which is derived from fossil fuel, particularly, for example, oil and gas. And I'm thinking about the Middle East. If you look at the Middle East, for instance, you can see that most countries in the Middle East, the major oil producers, they all announced in November last year massive, and it was ironic that it all happened at the same time, maybe the herd behavior. Some kind of projects related to hydrogen. What caught my attention was Qatar. So there was an interview with the Minister of Energy there, and even though you would expect, you see that gas and hydrogen would go together, but he explicitly said that they are not going to invest in that hydrogen until the technology is proven. So there is a lot of things said out there, and I cannot say which one would be more popular. So at the end, the technology has to be proven. It's not there yet. And for me, for Qatar to raise this kind of questions, there is perhaps a point in what they are saying. Let's wait and see the cost. Lots of these things will be at the end. It's the economics that will determine. And that's why I want to go back to one issue, Leila, that you highlighted, the carbon pricing. Remember, this energy transition that we're having today is pretty different from the previous transitions that we had throughout history, because it's driven not by more competitive prices, not by a massive industrial revolution, but by changes in preferences. And unless you cost those changes in preferences primarily through carbon pricing, I fear that anything where the technology is not properly proven is not going to take off well enough to speed up the transition.
Thank you, Carol. Thank you for tackling this difficult question of carbon pricing without me asking you. That's wonderful. A question to Dr. Anil. Apparently, there is evidence that India only had 36 years of accessible coal reserves. is the continued focus on coal in the country a viable way forward for energy security?
Well, these numbers that are commonly talked about are of, there are three categories: inferred, proven, and anticipated. So India's coal reserves are still not fully explored. And we don't think, that all the coal that we have will actually come out of the ground. So there's no dearth of coal. But as I mentioned, that the economics of generating power from coal has anyway taken a beating. And today you can get solar, and you see India has 300 clear, sunny, cloud-free days. And so solar and wind are today more economical than coal-based power. The only point is that due to the low CUFs of coal and of wind and solar, on one hand, where a thermal power plant can give you maybe 100% PLF, the solar at best gives us 20%. So you need to set up, 3 to 4 times minimum to be able to get that kind of. So there is a limit to that growth. So recently you've heard that some like US and India have announced a collaboration of financing, solar. And you also know that solar projects and renewable projects in general are lumpy. They are capex front-ended. There's no fuel expenses. So to be able to find that kind of capital and to create that trajectory of growth. So India needs electricity as of now. And I mentioned to you that last 2 months, there has been a feverish growth in power. So I think everybody knows that coal has a limited future, and there's no attempt to prolong that future in India. But then we cannot starve the country of power when we need it. Gas is too expensive. The LNG forecasts, which we just heard from presenters, in due course of time, LNG, when it gets commoditized, the prices may come down. But as of now, India has 26 gigawatts of gas-based power generation whose PLF is below 20-25% because of the high prices. So looking to the technology, the capex, the pricing, coal will support the grid and support the demand for the next maybe 5-10 years. I don't have those projections, but ultimately renewable is the way forward, not only for India, but for the whole world.
Thank you, Anil. And I would like to use the last minute that is left to have an answer maybe from Thomas. Because the methane question is coming back. We are being accused not to discuss methane enough. And methane is CO2 on steroids. So I think the question that allows itself is that in the previous session, people seem to assume that it will be relatively easy to monetize methane once you have captured it, if that's the easy acceptable solution over the next, at least the short to medium term. Do you see really methane capturing as low-hanging fruit? And do you see it as an easy solution where you can monetize methane easily? I mean, Anil has talked about 26 gigawatts of gas to power capacity. That's a huge.
To be frank, and to be frank, thank you, Leila, and quickly, I don't know if it's a low-hanging fruit solution, so what would be the cost of the solutions. But what is definitely sure is that the gas industry is today under attack also due to the methane leakages. And so the industry has to face boldly this subject. It's a matter of fact. Total has set very ambitious objective in this, and other players has too. The capture, the methane when captured will be monetized. So that's true that there is here two aspects: avoiding those emissions, so being really bulletproof in our process to be sure that there is no leakages first, and then after avoiding the emissions, because it's always, I think, the best solution, it's to find solutions to whether reduce them or capture them. technologies are there. We have to embark this journey. And we have also found Total is part of a OGMP, Oil and Gas Methane Partnership, to advocate collectively within the industry to be sure that the solutions that some players are taking could be spread all over the industries. I think it's very important, and the industry is tackling this problem seriously, very seriously.
Thank you very much, Thomas. And so for us to be bulletproof on timing, I'll have to cut this this fascinating discussion. I think I will not provide long concluding remarks, just to say that I think there's an agreement that there's a future. There's definitely a future for gas, and the industry will restructure itself and will definitely survive with hopefully nice margins in the future. So with that, I would like to turn the floor to our president, Keisuke. If you are still here, turn the floor to you so that you conclude this symposium. Thank you very much.
Thank you.
Thank you, Leila, for the excellent moderatorship, and also many thanks, great thanks to all the presenters for the very clear and insightful presentations in the second session. Thank you very much for that. Now, as Leila said, we are kind of running behind schedule, but let me move on to the final part of this event, which is the closing remarks by the respective kind of the organizers. So let me turn first to OPEC, to Dr. Ayed Al-Qahtani, Director of Research Division of the OPEC. So, Mr. Al-Qahtani, floor is yours.
Thank you very much, Mr. Sadamori, and good afternoon. Probably it's already a good early evening to a lot of us. In this concluding remark, if you allow me just to once again thank the co-organizers, the IEA and IEF, for hosting this event. Through this and many other important events and initiatives, together we continue to play a vital role in furthering the producer-consumer dialogue. And I hope that this and many other events to come in our trilateral work programs continue to flourish in the years to come. Before adjourning, I would like to just take a few minutes to touch on a few of the key takeaways from today's meetings. You may agree with me that throughout the day and in many presentations we delivered, we've listened to very rich exchanges of outlooks and forecasts, and we have certainly benefited greatly from today's proceedings, most of which was the opening remarks by their excellencies early on in the day. And based on the questions and answers sessions that we had, we engaged in after these presentations. I was very impressed to see the high level of participation and avid interest in pressing issues that we have discussed. Indeed, today's deliberations were highly productive in use of time, as they are all issues that we need to address in our future meetings in the many months and years to come. In session one, we heard presentations on gas and coal market developments and outlooks from a variety of perspectives, with a focus mainly on the short-term issues. We've heard outlooks and prospectus of China's coal industry, as well as an update on the recovery of LNG and the new trends of gas decarbonization. In session two, we heard highly insightful presentations on the medium to long-term outlooks for coal and gas, and we heard some very valuable remarks on India's coal industry, as well as the role of coal and gas in the energy transition. Before closing, I just want to re-emphasize on the high importance of global energy cooperation and dialogue, and urge our partners here to continue doing the good work of expanding the outreach amongst the industry partners, so that we all can more effectively address our common challenges and achieve mutually beneficial outcomes. From this end, Mr. Chairman and distinguished guests and colleagues, OPEC will continue to prioritize the multilateral energy cooperation throughout the extensive dialogue program that we have here at the Secretariat. We have an extensive portfolio of bilateral and multilateral meetings that we maintain and hold on more frequent basis, most importantly with international stakeholders, including European Union, Russia, China, India, Africa, the US, the World Bank, the IMF, India, Africa, and so on and so forth. Indeed, we wouldn't forget the IEF and IEA, the more recently the GECF, whom have attended with us today. It was the US civil rights leader, Mr. Chairman, Mr. Martin Luther King Jr., who said, quote unquote, "We may have all come from different ships, but we are in the same boat now," end of quotation. And indeed, we all come from not only different countries, but also different organizations and institutions and companies. However, our reality is that as an energy industry stakeholders, we all face many of the same challenges, and thus must work together to achieve our common objectives. There is no doubt in my mind, or anybody's mind who's attending today, that our ongoing endeavors geared toward building bridges and deepening ties on the global stage will benefit not only producers, but also consumers and everybody who's involved or engaged in this global macroeconomic and energy markets, while contributing to the economic growth and prosperity, two things that we are all desire for this future generation. Without further ado, I keep my remarks short, Mr. Chairman. I turn the floor back to you. Thank you.
Thank you for this very nice concluding remarks. Yes, we are in the same boat, indeed. Now, let me turn to the Christophe Van Acht, the Director of Energy Dialogue at the IEF. So, Christophe, floor is yours. Thank you.
Thank you very much. Indeed, on behalf of the IEF, I would like to thank the IEA for hosting this excellent fifth joint symposium on gas and coal market outlooks, together with ourselves and OPEC, of course, who I really must thank for their steadfast support. Thank you also, Keisuke, for your excellent chairmanship. And of course, I would like to acknowledge Dr. Ben Youssef and Dr. Leila Ben Ali for their inspiring moderation of the expert discussions and the distinguished speakers that indeed represent stakeholders from all regions of the world for their really well-informed and real-world insights. So in wrapping up, I would like to be very short and concise and just summarize the paradox with which we are struggling here today and which will be with us for a while. On one hand, of course, we will continue to live in a hydrocarbon economy, while on the other hand, sustainable development and rising ambitions to achieve our collective climate goals require emissions to fall at an accelerated pace. The only way to square the circle, beyond assertive deployment of renewables, of course, and energy efficiency gains, nuclear, is stepping up investment in clean technology, RD&D, and deployment in the gas and coal sector. Reaching for the higher hanging fruits is really what is needed now. So we rightly placed emphasis on the need to step up these efforts and accelerate plant efficiency, gas to coal switching. Here, of course, eyes are on the non-OECD region, eliminating methane emissions that can be done at acceptable cost, if not, better still, a profit. But most importantly, we must move forward more expeditiously with carbon capture use and storage technologies and other carbon abatement solutions such as circular economy and carbon models. We noted that even without a global price on carbon, I think it was Tatiana Mitrova who said this, the license to operate will push the energy sector forward much more forcefully in this direction. So ensuring that the evolving environmental social governance standards acknowledge the role of these overlooked technologies is really what is important here to help us get there. So the IEF will reflect on the outcomes of this very rich sessions. And indeed, we are happy that we have done this publicly and we have departed from the Chatham House rule. We will make these proceedings available on our intersets. And we will look forward to launching new initiatives to expedite this process together with the IEA, OPEC, and other partners shortly, indeed, to help align public opinion and expectations with those of the expert opinions we heard here today. In the build-up to COP26, the UN High-Level Dialogue on Energy, and of course, last but not least, the 17th International Energy Forum Ministerial, all taking place this year. Thank you very much. Keisuke, I hand over back to you.
Thank you, Christoph, for this very concise but very nice takeaways from the discussion today. Let me deliver the concluding remarks from our end at the IEA. So, distinguished guests, ladies and gentlemen, as in the past 4 symposia, today it was my great pleasure to hear your insights and perspectives, particularly when the future of gas and coal are so uncertain, and their respective roles in the energy systems will have major implications for clean energy transitions and fight against the climate change. Today, we gathered 200 participants in this virtual symposium and several hundreds following the symposium live stream. Let me try to be a bit brave and try to summarize some of the kind of key findings, messages of what we have heard today. So first of all, the COVID-19 and the market uncertainty it brought has been a stark reminder on the importance of strengthening the dialogue between producers and consumers to ensure the greater market transparency and stability. A tentative rebound in demand is underway. In the short term, both gas and coal are expected to recover this year in 2021 to levels above that of 2019. LNG demand is also recovering strongly. And in particular, gas has room to grow, at least for now. And coal, by contrast, will decline slowly. As the growth in developing Asia is not enough to offset the declines in other parts of the world. And one of the kind of a common point is that the climate change policy is a major uncertainty, with 44 national governments making net zero pledges. And if they really comply with their pledges, then they will see a very steep decline, steep drop in coal demand by 2040. And also natural gas, they will also need to peak soon and begin a decline. Overall, in terms of the kind of long-term perspectives, innovation is needed to ensure the energy security and low emissions. Reducing methane emission is a key prerequisite for gas to remain a viable transition fuel in a decarbonizing energy systems. And another technology, CCUS, is key to a successful energy transitions. So with so many uncertainties in the energy system ahead of us, today's dialogue was certainly very meaningful in seeking common solutions. But it still leaves numerous, the unanswered and challenging questions on how both fuels, natural gas and coal, can play their roles in reaching clean energy transitions. Establishing a continuous dialogue between all relevant actors is the only way to find the answer to these questions. So the joint initiatives between our 3 organizations, including this symposium, are examples of such dialogues. The kind of talks between our organizations and among our respective member countries are also important. The organization of this event is the work of many people in our three organizations. And I would like to thank particularly to Mr. Cressy of the IEF, Dr. Fard of OPEC, the Peter Fraser, Carlos Fernandez, and John Baptist JB of the IEA for their contributions in directing this meeting. But the success can be attributed most to the very hard work of three people, Song Ho Jun, who had the lead responsibility, and Main, who spent many hours on the administration, and Etienne, whose technical support is invaluable for the successful the virtual meeting. And of course, I would like to thank our distinguished moderators, Dr. Ben Youssef and Dr. Leila Ben Ali, for their excellent moderatorship, and also to the great speakers for their presentations, and also the audience participants for their incisive, good questions. So, distinguished guests, ladies and gentlemen, thank you very much again for your participation today. We look forward to seeing you again, hopefully physically, face-to-face, in the future events. I now declare this meeting adjourned. Thank you and see you soon.